record on the computer. So our last part of the discussion, we looked at capital rationing. And we said in capital rationing, what you needed to look at. Maybe we didn't do an example, but look at an example on capital rationing. Probably example on capital rationing before we start our basic discussion. We are going to move a bit faster so that we can finish the investment today. So let's look at this example before we, it's part of what we made in our previous class. So company X has received 8 investment projects from the project team as below. So these are the project 1, 2, 3, 4, 5, 6, 7, up to project 8. And this is the amount required, the initial outlay of the project. And this is, I added the wrong here. I added the NPV and I wanted this one. Maybe I can increase here. So the whole projects require 1.8 billion for investment. The management team has provided, maybe I can add here, has provided 1.2. 1.2 billion for the next investment. That's the money required. So automatically, by looking at this, by looking at the total amount that is required, 1.8, and this amount that was allocated, automatically it tells you that there is a capital action. By just looking at the total amount which is required and the available funds, automatically it tells you that you are dealing with a question that requires a capital rationing, because all the projects are profitable because they have a positive NPV. The money required to invest in all those projects, if the funds are available, you would have required 1.84 to invest in all these projects. But because funds are limited, you have to exercise a capital rationing. You have to, yes, please. Where you go? Oh, you're on the phone. So that is a capital rationing decision. So sometimes you may not need it to be, just look at the funds required and the funds available. Make your decision. Look at whether you are dealing with a capital rationing or you're not dealing with it. Sorry, I'm coughing. So then the required is assuming the projects are divisible, show how resources will be allocated. And what will be your answer? The projects are not divisible. Now, when you are dealing with this, as we said, when you are dealing with a divisible project, your decision is based on profitability index. If you are dealing with if you are dealing with the divisible projects, your decision should be based on profitability index. So if I can maybe copy the same information down here. If I can copy the information down, what I need here is my PI, the profitability index. Then after getting the PI, I need to rank the project depending on the profitability index. Now, if you look at this, I have the NPV. How do I get the PI? You remember in our discussion, we said PI is equal to PV, the present value, divided by the present value of cash flows, divided by the initial investment. Or you are getting the NPV divided by IO, then plus 1. So it means in this case, I'm going to use my PI. So I come here, I'm just going to use the formula, I think. It's going to be this, divided by this, then I add 1. I've used the second formula. So it means in my project 1, the PI is 1.65. So I can maybe scroll down now. Those are the PI in this. Now, what do I need? Now, the second step, is to rank my projects. If I'm ranking, I'm going to rank this as project number 1. It has got the highest. Project 1. Then this one is going to be project number 2. I think this one is project number 3. This is project 4. This will be project 5. Project 5. This will be project 6. This will be project 7. And this is going to be project 8. I've done the ranking of the projects. So it means when I'm allocating, I will allocate the resources depending on the rank, on the order of the ranks, from project 1 until the resources that are required are finished. I mean, until the available resources are finished. Now, once I finish that, I do on allocation. Allocation of resources. Remember, our project number 1 is we are going to allocate project 5. These are the project. Then I recognize the initial investment of the project. Then what it required, allocated funds or allocation. Then the NPV of the project. We are allocating to project number 5 first, because it is our number 1. Project number 5, it requires 300. Its NPV is this. Hey, so the amount we are allocating is the same. We are going to allocate this. And its NPV is this. Another project where we are going to allocate project number 8. Project number 8 requires 200. And we are going to allocate 200 on this project. Then the resource, the NPV of the project is 140. The third one, where we are going to allocate, is project number 2. We have project number 2. Project number 2 requires 180. And how much I'm allocating? The same, 180. What is its NPV? NPV of project number 2 is 120. Number 4, the next project is project number 4, which we have ranked number 4, which is project 1. It is project 1. Project 1 requires an initial investment of 100. And we are going to allocate the same amount because we still have the resources. The NPV for this project is 65. Remember, we cannot exceed 1.2 billion in our allocation. This is already, we have around 700 plus. So the third project, the fourth, is project number 4. Project number 4, it it requires 80. It's going to give us an NPV of, hey, the money we allocate, we are allocating the same amount. It's going to give us an NPV of 50. Then the next project, we add here, we have how much? We still have the resources. We have 860, still have the resources. I go to project, I have branch number. Project 6. It requires us this amount. It will give us, we shall allocate the same amount, and it's going to give us an NPV of this. So how much do I have now? 1.1.
Excuse me.
Yes?
Number 6 requires 450, I think.
The one with, no, 450 is in number 8.
Project 6.
Project 6 requires 280.
Sorry?
It requires 280. Isn't it? This is the one which is wrong number. Don't look at the number.
Okay. Now I see.
Yeah, this
The
is
ranking.
Yeah, now I get it.
Okay. Now, the next project, remember now, if we add here, you have 1.140. You only need 60 to finish the available funds. So, but since the projects are divisible, you can start this another project. And so it means we are going to project number 3, because it is the 7th now. Project number 3, it requires an investment of 250. But basing on the available fund, we are only remaining with 60 to finish the funds. So it means the funds have been exhausted. 1.2. And these are the funds which were the project required. It required that, but we have allocated 1.2. What will be the NPV for this project? Because you are doing it partly, you're not going to finish the project. It means you must make a proportionate. Hope we are getting each other. You are going to make a proportionate of the project number 7. Well, I think project number 3. Sorry. We are making a proportionate of the funds allocated divided by the funds required.
Excuse me.
Then multiply by, yes, please.
Here we are under the assumption that the projects are not divisible. So the project.
We are answering part A. The projects are divisible.
Okay. Okay.
Isn't it? So this is how we are going to allocate the funds if the projects are divisible.
Come back a bit on the formula.
Oh no, you get the funds allocated. When you want to allocate the funds allocated, get this one. The NPV for the last one where look at the funds allocated over the funds required times the NPV of that project. Funds allocated divided by the funds required times the NPV of that project. Then you are going to get the NPV to allocate. for that allocated, for that project you are going to do part.
Can you put the formula on the top to help us?
Where, around here?
No, NPV.
Huh?
On the NPV.
Because we are looking at
up.
it. No, this one is the same. We are not getting it. The only way you are calculating is here. Because you have allocated the only money. You have not used the whole money. For this where you have used all the money, you don't need to allocate the NPV. So here we only look at the proportion of the NPV to the funds allocated. Maybe I can write it here or down here.
Yes.
Proportion of NPV for the funds allocated. You are getting funds allocated divided by funds required. Then times the NPV. Sorry. So you'll get the fund. That's what we have done here. 60 divided by 250, then times the NPV of that project. Project 3. Then you can get this. We are just proportionating. I don't know if you have a question on this. Any question on this? Remember, we need to finish investment today. So then the next, when the projects are not divisible, if projects are not, if the projects are not divisible, if the projects are not divisible, we said what you need is a combination of NPV that gives the highest. A combination that gives you the highest NPV. That's what you are going to take. Now, if projects are not divisible, I don't know if I can take this. These are the projects. And I need a combination which gives me the highest NPV. So we can look at this, and it uses as much as possible of our resources. If I take my first combination, this is the combination. Maybe I can leave a space here. This is my combination. And I make this one the IO. And here I have the NPV. Because what I need is a combination that's going to give me the highest NPV and exhaust as much as our resources. So if I take, I think I can start with project 5 plus project 5 plus project 7 plus project 8. Remember, you cannot exceed the amount. Project 8, I think if I add project 4, how much will I need in project 2? Let's see this one, whether this combination can work. Project 2, how much? This is this, project 5 plus project 7 plus project 4 plus project 2.
Excuse me.
How have I added? I've added wrongly.
Excuse me.
Yes, please.
Yes.
Project
You are
this?
adding NPV instead of
Yeah, okay.
initial
Project
investment.
plus project 7 plus project 8 plus project 2. We can add another one, I think.
We still have resources.
But you did not pick the project 6, and it is the biggest.
With the NPV. I'm looking at the NPV.
With IU.
Now we look at the combination that gives us the highest NPV.
Okay.
We can add the project what? We cannot add this one. It will be exceeding. We can add project. We can add, I think, project. You can add project 1. You can only add project 1. Or we can add. We can't add project 7. Only add project 1. And if you add project 1 here, I think that's all. How comes? Okay.
I haven't added any project 3.
Project 3.
It can't work. Yes.
Now, if you add project 3, I think it is going to exceed. Okay, let's add project 3 and let's see. We remove 1. If you add project 3, if you add project 6, it exceeds. It is exceeding.
Project 4.
Project 4 is 80, but it has got the lowest NPV compared to project 1. Hey, we can add project 4 and 1. I hope the resources are available. We can add project 1 plus project 4. Yeah, it works. So the NPV will be 5 plus 7.
Then what would that mean? If we are selecting the combination with the highest NPV, we are including the one which have the lowest NPV.
No, because what we are looking at, the resources we have, we would have selected project 4 here, this project. But taking this project, we don't have the resources. That's why we are opting for the one which have got the lower to finish our resources. Because we cannot take project 4 when we have other projects, like maybe if you have many projects. Maybe you can try then another combination, including project 4. We didn't take project 6. We took project 4. We took project 2 to project 1. That will be the NPV for those 3 projects. For those projects. These are the funds required. And this is the, then you can go for another combination. And then you will select a combination which gives you the highest NPV. Now,
is there any guidance? Is there any guidance regarding the number of projects that you are going to combine?
No.
For example, here you have combined.
What you need is to look
Okay.
at project that exhausts your resources and it gives you the highest NPV. That's the only guideline that you take. Projects which exhaust your resources and it gives the highest NPV.
Okay.
So you can try, but what I want you to maybe to look at the mutual exclusive. Sometimes, like a question, there is a question, is in 2018. You will look at that, mutual exclusive projects. Because sometimes they may tell you project 1 and project 3 are mutual exclusive. Project 5 and project 8 are dependent. So you need to look at those conditions given in the question. If some projects are mutual exclusive, it means taking one project will not take another project.
Well,
You are saying?
mutual exclusive, the one you take one project, you have to, you
Don't
don't
take
have to take
another.
the other one.
Yes. So if one project is taken, another project is not taken. Those are mutual. If you take one project, you're not going to take the other.
Excuse me, sir.
Yes, please.
If you are combining the initial investment of project 5, 7, 8, 2, and 1, I
Yes,
can't
please.
see why I can't see why you get 1 million.
There is another project 4.
Another project 4.
Yeah, probably it is
Okay.
hidden here.
It's not. Okay.
There's a project 4 which you have added here.
Okay.
Dependent projects. That is another thing that you should look at when you are looking at this part of either from the divisible, not divisible. Look at the conditions in the projects. If we say that the projects are dependent, it means taking one project, you'll have to take another project. For example, if you say project 1 and 2 are dependent, it means automatically you choose project 1, you'll have to choose project 2 if the projects are dependent. So taking one of the projects, you'll have to take the other project. If we say the projects are dependent, if you take one project, you have to take the other project. If projects 1 and 2 are dependent, taking project 1 automatically, so that is going to affect the way you're going to choose your projects. For example, you may say project 1 or project, we had the number 1 was project, we come here. When we ranked, if we ranked here, if we say this was our first project, project 5, and they tell you project 5 and project 6 are dependent. You see that automatically by choosing project 5, we would have to choose project 6. So you need to be very careful at some of those conditions in the questions, whether the projects are dependent or the projects are mutually exclusive. I think you can look at that question. Is it in 2018? 2018. Look at that question of 2018. I don't remember the seating, but I think remember it is in 2018, where we had this question on capital rationing. So I think this is what we covered when we met last time. I don't know if you have a question on this.
Did we exhaust maybe the
We have not
combination?
exhausted all the combinations, but you can do that. But we have not exhausted all the combination. You can select another combination that you see. I'm not saying this is the last, this is the decision. You can check another combination that gives us the highest. Can you, do you see any? By the way, if you take this combination, this one, oh, it was this combination. How much was the NPV? If you take a project T, but this one, we remove this one. You take a 5, 8, 2, 1, 4, 6. It was giving us how much? If you take these ones, so I can use the sum. It would give us it is the same that we have taken, I think. So you can please select, look at for another combination that gives the highest NPV and the C, and select the combination but gives the highest NPV. So that is what we covered in our last class when we met last time. So I don't know if you have a question, please, before we start something else. Any question?
Excuse me, sir.
Yes.
Come again on mutual exclusive. In these projects, which ones are those?
No, I didn't. I just talked about incident. In some question, they can tell you that some projects are mutually exclusive, some projects are mutually dependent. But I just wanted to give highlight. They are in this case, is not provided for that condition. Is it okay, Doreen?
Even most of the questions which are given
Yes, it's
on
okay.
the capital rationing,
Yes.
they include those conditions mutually exclusive or dependent.
Yes. That's why I gave you this, that you should be able to look at that. If it is mutually exclusive, if you take one, if say project 1 and 3 mutually exclusive, means if 1 cannot take project 3. Take a project 3, cannot take project 1. But if we say project 1 and 3 are dependent, it means by taking project 1, automatically you have to take project 3. So the next part that I want us to talk about is the placement. The placement decision. That's the next part that I want us to talk about. The placement decision. Now, replacement decision, it's about whether to replace an asset or not. And if you are to replace an asset, when should you replace that asset? So the main issue here in the replacement is about whether to replace the asset and when to replace the asset. So this involves evaluating whether to replace an asset and when the asset should be replaced. So you may be having two assets also, or you have one asset that is ongoing. You want, when should you replace an asset? Or you have an ongoing asset and you want to say, when should you replace the, because in the asset, most of these non-current asset, as the time goes on, the residual value of the asset reduces and the maintenance cost of the asset increases. So your worries, as you are going to, as you are using the asset, you may find that you are going to incur high cost by continuing to use the asset than replacing that asset. So you want to evaluate, should we continue to use the asset and incur this maintenance cost, or should we replace the asset with another asset? And when should we replace this asset? Or if I have two assets operating, which one should I replace first? If they are the same categories. So these are the decisions that we always make in a replacement. So the first part that we're going to look at is going to be our part one. When that's the first question we are going to look at. When to replace an asset. When should we replace an asset? So the business or the entity should replace an ongoing asset or an existing asset when it is incurring the lowest annual equivalent cost. Where you will be incurring the lowest annual equivalent cost, that's when the business should replace an asset. So the entity should replace an asset where it incurs the lowest equivalent annual cost. We always abbreviate as ESC. And what is our ESC? Sorry, it is the lowest cost in the all periods of the asset. It's the common cost, not the lowest. Common cost. The common cost in the all periods of the asset useful life. So if you look at the common cost that incurred in all periods of the asset useful life is what we call the ESC. And what are the steps here? What are the steps to determine when to replace the asset? Step number one, determine the present value of each cycle. That's the first step. Determine the present value of each cycle. Each period or each period of the asset is considered to be a cycle. Each period is a cycle. So you're going to determine the present value of each cycle of the asset. Cycle 1, cycle 2. No, if, for example, you look at it, if suppose the asset, each period is not, if the asset has a useful life of 4 years, we will have the first cycle, the second cycle, the third cycle, and the fourth cycle. So each period is going to be a cycle. Step number 2, determine the ESC of each cycle, which will be equal to present value of the cycle divided by the annuity factor. So you're going to get the present value, you're going to get the ESC of the cycle, which will be the present value of the cycle, the total present value of the cycle, then divided by the annuity factor. Then the last step is to assess the lowest ESC. Assess the lowest ESC. And that's what you are going to, that will be the cycle that you are going to take. I mean, that will be the period where you should replace the asset. Let's look at a simple example here. Company X is evaluating when to replace its machine. Company X is evaluating to replace its machine. The cost of the machine is 100 million. And we'll have the following maintenance costs and residual value. I'm going to remove 3 zeros because it will disturb me. 10,000. The residual value will be 85. It's a residual value. If we maintenance cost here will be 10 million. And residual value will be 70 or 68. We are going to incur 25 million. And we can sell the asset at 50. We're going to incur 35. We can sell the asset at 30. So that is what we have here. Required, I can even write it here. Required, the cost of capital, I have not said it. The cost of capital is 10%. So assume that. Required, determine when to replace the machine. Let's have this. So now, what we do, we said each period is a cycle. We have here 4 periods. We have cycle 4, cycle 3, cycle 2, and the cycle 1.
Scrap a little bit.
Huh?
You scrap. Little. Again.
The example is starting from here.
Yeah, it's okay.
We move on. So let's look at the cycle 4. Our first cycle. Cycle number 4. Cycle number 4, you have the period. We are assuming that the asset is replaced in year 4. That's the cycle 4. The asset will be replaced in year 4. So if we are to replace the asset in year 4, you'll have years period 0 when you invest just the asset, period 1, period 2, period 3, period 4, and period 5. Of course, this is 100 minus this will be, I took the maintenance cost.
Excuse me, sir.
Maintenance cost in period 1. Yes, please. Maintenance cost.
Why you start on?
You know, the reason I want to start with the period 4 becomes simple to get of the data I'm going to use. But you can start with the period 1, but you are going to repeat everything. But when I have period 2, start with the last period, it becomes easy. Because other data will just be copying. That's why I like to start with the last. These are maintenance costs.
If it is cycle 4, where comes the 5?
No, it should be 4 again, not 5. Because we only stop at 4. This should be 4 again. And the 4, we have a residual value of the asset, which is 30. These are our cash flows. Now we have our discounting factor at 10%. So this is going to be 1 plus 0.1 power minus this. I think I can reduce like this. So this is the present value. The present value, and I just multiply this times this. So I can add, and I will get the present value of cycle 4. So that will be the cost. Suppose the asset is replaced in year 4. Now, suppose we replace the asset in year cycle 3. Will it confuse if I write it here? I go down, I can write it here.
Put
Down.
it down, it will confuse
Down.
us. It's better to write it down.
Suppose we do cycle 3. Cycle 3, we are assuming we are replacing the asset in year 3. So what I do, I just copy this. That's why I say I prefer that this one I just copy. I copy this. I think they okay, they have come out. I copy this. Hey, they are not, yeah? Is it true? As if I'm not getting the same ones.
True, but you have to add residual value.
This is year 1. No, the answers are not correct.
It's not true as cash flows are not the same.
Year 1, it should be 10,000. Why am I getting year 1 is 18? Year 4, yes, year 3 again. It's going to be what's our residual value in year 3? It is this. So if we replace here, this will be our present value cost. If the asset is replaced in year 3, that will be the cost. Now, suppose we replace the asset in year 4, we get cycle 2. Cycle 2, we are assuming that the asset is replaced in here. So I'm going to copy this. This time I'm thinking I should copy figures, not copy figures. Hmm. Okay. Then I add another cycle through here, which is the present, which is the residual value. This will be the residual value. So now I'm assuming the asset is repressed. I'm going to cycle 1. Cycle number 1. I'm assuming that the asset is repressed in year 1. So if I assume that the asset is repressed in year 1, it will be so this is year 1. So it means this will be the present value. In the case the asset is repressed in year 1, that will be the cost. Now, once I finish this, that was first step number 1. I think if you look at our steps, step number 1 is to determine the present value of each cycle. Then step number 2 is to determine the ESC for each cycle. So now what I'm going now is to determine the ESC of each cycle. The ESC of each cycle. I have cycle.
And we put them on each cycle we have calculated.
Yes.
Can we put on the right side of each cycle we can?
Let's put it down here. We have the annuity factor, the PV of cycle. Then I can have annuity. Then I'm going to have the ESC. I have cycle 1, cycle 2, cycle 3, cycle 4. Cycle 1, we have got this. Cycle 2, we have this. Cycle 3, we have this. And the cycle. Then annuity. I'm going to use the formula, or if you have the table, you can take it. 10%. We are looking at annuity factor. So I'm going to use the formula. It's 1 minus 1 plus 0.1 power power minus this then what I get divided by 0.1. So that is the annuity. Now, what I get here is the SC now. And we said, get the annuity, the cycle, sorry, divided by the annuity factor. That is cycle 1. Cash flow divided by the annuity factors. So it, yeah, it gives us this, but that's the data we put in. So it means this is our lowest. So this asset should be replaced in period 1. I think, of course, the data are imaginary. If you have actual data, you get the right period. I don't know if you have a question here. Yes,
I
Why
have a
you
question, sir.
you may come again. Why you take the period you want to be used as replacement period?
We said we replace the asset at the lowest ESC. Where do you have the lowest ESC? It is year 1.
It is in year 1.
Yeah. Another question?
To calculate the ESC, it is take the PV divided by annuity.
Annuity factor, yes.
Okay.
So you should also write that formula.
The formula is here. It is step number 2.
Step number 2.
Number 2. Determine the ESC of each cycle.
Okay, I can see.
So that is replacing. When to replace the asset. Another part here. Or another question that we should ask. Which asset to replace? The first question was when to replace. And we said we are replacing where we are incurring the lowest ESC. Now, the second part is which asset to replace. So if I have 2 assets, asset 1 and asset 2, which asset should I replace first? Still, the decision is the same. You are going to compute the present value of the cycle, each asset. Then determine the ESC of each asset. And then determine the one where you have. I think you have heard. Look at the steps. Step number 1, determine the present value of each asset at the end of the cycle. At the end of the cycle, what is the present value of that? If the asset has a useful life of five years, what will be the present value of that asset in 5 years? If the asset has 3 years, what will be the present value of that asset after 3 years? Then, step number 2, you determine the ESC of each asset. Of course, you'll get the present value of the cycles or the present value of the asset divided by the annuity factor, which we have seen in the other part. 3, the asset with the lowest ESC should be replaced first. The asset with the lowest ESC should be replaced first. So these are the simple steps on which asset to replace, similar to what you have seen in the previous part. So maybe I can test you with this. Maybe you can give me the answer. Company X has got 2 machines. Which are A and B. For both machines, let's assume both machines were purchased at 50 million. At 50 million francs. Machine A has a useful life of 5 years, while machine B has a useful life of 4 years. The cost of capital is, let's use the same 10%. And these are the cash flows. Cash flows machine A. I have year 1, 2, year 3, 4, year 5. These are maintenance cost. Period, yeah? Have maintenance. It require 5 million here. It requires 7 million. It require 10 million. 12. It require 15 million. And our residual value in year 5. The residual value in year 5 is 26 million. Then machine B, one, two, three. It has a useful life of 4. Maintenance cost. Then our RV in year 4, 30. So, which machine should be replaced first? That's required. So that is the data we have. I hope you can handle this. These are 2 machines that you are having. Okay, maybe not to take a lot of time. We're taking machine A. Machine A. So this is our residual value. I don't know how I can make this one. I need year 0, year 1, year 2, year 3. Year 4, year 5, year 5. Let me make this one a minus. Hope it will not affect you. So you are going to do what's the present value of the asset at the end of your cycle. So I'm going to do the discounting. So I get this times this. So if I add, I will get this. That will be the present value of this asset at the end of year 5. Then, if you go for machine B, or I can even compute my ESC. So what will be the annuity factor at the end of year 5? Annuity factor at end of year 5. So I think I can get it here. So it means my ESC will be that for machine A. Now, if I go for machine B, I don't think it's almost the same. I think I can even do it. Machine B. Period 0, period 1, period 2, period 3, period 4, period 4, I think. I can copy the cash flows. This is 50. Remember, this is a residual value. They are the same. I think I can copy this up to here. So I think we can now call this. Okay. So what is the annuity factor in year 4? Annuity factor in year 4. It's going to 1 minus divided by so what will be our ESC? So from here, it is evident that we have to replace asset machine A before replacing machine 2, because that's where we have the lowest ESC. So replace machine A before machine C, machine B, sorry. I think, I don't know if you have a challenge here again on this part. Any challenge?
Yes, what do you not calculate the cycle of each of the, for example, year 1, year 2, year 4, year 5?
Because we are looking at whether to replace, and this is a different decision we are looking at. We look at when we are not answering when should we, but we are looking at which asset should we replace.
Okay.
Yes. You only look at the other when you are looking at when to replace the asset. Is it okay?
Okay.
Hello.
Yes, please.
Yeah, for the previous example, we've taken a decision with the lowest ESC.
Yes.
Please scroll up and first we look at those numbers, then I can ask when I'm looking at them. Yeah. You see, the values obtained, they are all negative values.
Yeah, only that here I changed because these are cost, but only I changed the figures because but it's still the same. You could make this one a positive and make this one as a negative. It's going to give you the same, but it doesn't have any effect. Know that these are costs. This is an income. It may not affect your answer. You can check, make this one.
My question is, sorry, sir.
Yes, please.
Once all the values are negative, so I'm totally confused. Mathematically, if both are negative numbers, that one is not the lowest number.
Please, don't look at negative as a negative sign on mathematical number. Look at a negative in finance as a cash outflow.
Okay.
Yes, look at a negative in finance as a cash outflow. Don't take it as a negative sign on a number, but look at it as a cash outflow.
Thank you.
Okay. We are answering decision number 3. Decision number 3, the first decision in a replacement was we need to replace an asset. We have looked at that. The second decision was which asset to replace. And we have looked at that in a replacement. The third decision is whether to replace an existing asset with a new asset. Replacing an existing asset with a new asset. Replacing an existing asset with a new asset. That is our next part. Now, in this, you may be having two assets as we are looking at that. We have an already asset and you want to replace an already asset. I've heard someone knocking. You are replacing an already asset with a new asset, and you are making a decision whether it is viable to replace that old asset with a new asset. Now, when you are making a decision, the decision is based on incremental cash flows. What are the incremental cash flows associated with the two assets? If you evaluate those cash flows using the technique required, then from there, you can make a decision whether to replace or not. As long as you are having either positive NPV, an IRR that is above the cost of capital, in that case, or you have a PI that is above 1, then in that case, you are going to replace an existing asset with the new asset. If, for example, if you get a negative NPV, it will not be viable to replace the existing asset with a new asset. So, in replacing an existing asset with a new asset, what you do is to evaluate the incremental cash flows associated with the new assets. What are the incremental cash flows which are associated with the new assets? So look at the cash flows associated with the old asset and the cash flows associated with the new, and determine the incremental cash flows. So the decision to replace an existing asset with the new asset is made by so you are saying you are going to look at the incremental cash flows associated with the new asset and evaluate them using an appraisal technique. So you're going to look at the incremental cash flows associated with the new asset and evaluate those incremental cash flows using the appraisal technique. So, what are the steps here? Which are very important in this. Step number 1. Step number 1, determine the incremental investment costs. What is the incremental investment cost? Because you are purchasing a new asset to replace an existing asset. So it means the money you are going to sell from the existing asset will reduce the cost of the new asset. Then you are going to get the incremental asset. So you are going to have the purchase cost or the cost of new asset. Cost of new asset. Get the cost of the new asset less market value. Please mute. Market value of all the asset. Get the cost of new asset less the market value of the old asset. Then consider any tax saving or tax payment on the old asset. Tax saving or payment on the asset. How do we get this? Now, our tax saving or payment on all the asset. You're going to have the market value of all the asset. Market value of all the asset less the book value. the book value. Now, what you have here is either gain or a loss. It can either be a gain or a loss. If it is a gain, you'll have a tax payment. Then you recognize the tax. If it is a gain, you are going to have a tax payment. If it is a loss, you'll have a tax saving. A tax payment increases the cost. A tax saving reduces the cost. So here you can have either plus, or if it will allow, or a minus of that. Wow, it cannot accept. You will see how to not, but it can either be plus or minus. If it is a gain, you recognize the tax payment, which is going to be an additional cost. If it is a loss, you will have a tax saving on the loss and recognize a saving, which reduces the cost. So what you are going to have here is the incremental cash flows. Incremental investment cost. Incremental investment cost. Hope it is okay there for the first step. Step number 2. Step 2. Look at the incremental depreciation. Incremental depreciation. So what is going to be the incremental depreciation? Look at the depreciation of the new assets. Depreciation of the new asset less depreciation of all the asset. Less depreciation of all the asset. Look at the depreciation of the new asset, you less the depreciation of the old asset, then you get your incremental depreciation. That's step number 2, sorry. Because what we look here are the incremental cash flows. What are the incremental cash flows associated with the new asset you are purchasing? Step number 3. Step 3. You're going to determine incremental residual value. Incremental. My network is not stable. I don't know what has gone wrong. Incremental residual value. Incremental residual value, which you are going to look at still, the residual value of the new asset. Residual value of of new asset. You less the residual value of old asset. What you are going to have is incremental residual value. So that is step number 3 when you are adjusting your incremental cash flows. Step number 1, you said you're going to pay the cost. Step number 2, look at the incremental depreciation. Step number 3, we are saying look at incremental residual value. Now, step number 4. Step 4. Determine incremental other cash flows. Determine incremental other cash flows. Look at the incremental other cash flows. Now, what you do here is to look at the 2 assets. Look at your old asset or look at the new asset. Then look at the old asset. And here you have the increase, the incremental. So look at, for example, your revenues. Look at the revenues. Now, what are the revenues associated with the new asset? Then what are the revenues of the old asset before the new asset is purchased? Then look at the increment. Now, look at operating costs. Operating costs. What is the current what's the operating cost associated with the new asset? What are the operating costs for the old assets? Then what will be the incremental? Look at working capital. What is the working capital requirement for the new asset? What's the current working capital requirement? Then look at the increment. Then these are the key steps to evaluate a project that requires replacing an existing asset with a new asset. So once you have these cash flows, what remains is to determine your net cash flows. So the step number 5 is to evaluate the cash flows. Step 5, evaluate the cash flows using appropriate investment appraisal.
Is it evaluate the cash flow or the free cash flow?
No, you are not. We don't have year 3. We are evaluating all the cash flows using an appropriate investment appraisal.
No, what I'm asking, is it cash flow or is it free cash flow?
We are not yet in the free cash flows. We shall discuss free cash flows, but we are looking at these incremental cash flows. We have not yet discussed the free cash flows. We shall discuss the free cash flows in another part. And I was planning to discuss it in mergers and acquisition, but we can also talk about it here because it's also used here. Now we start with your incremental revenues. Incremental revenues. Then you can have any incremental operating cost. You can have now your net cash flow or earning before tax, EBT. EBDT. It depends on my cash flows. I can consider the way we looked at it. I can less depreciation if I want that way, or I can compute the capital allowance on the depreciation. Depends. The tax saving on depreciation. Unless depreciation. Then I get the EBT. Then I charge tax. Charge tax. Charge tax. I get my EAT. Then add back the
Is it to less depreciation or incremental depreciation?
The increment. Okay, incremental. Add back an increment. Incremental depreciation. Then I'll have the net income. Then I can consider my residual value. I can consider my working capital, which can be positive, can be negative, depends. I can have my net cash, net incremental cash flows. Then I can have, depending on the appraisal technique I'm using, my discounting factor. Then I get the present value. Then from there, depending on what I'm calculating, I can get the NPV I can get the IRR, I can get the profitability index. But these are the key steps to do this question. So I want to give a simple example. Then we look at a question of 2021.
Excuse me.
Yes.
Excuse me.
Mm.
Before you go to an example, in this formula, you haven't included in investment.
Because I'm not putting any investment, because investment is going to depend on the technique we are going to use. If I'm going to use any PV, then it means I'll get the present value of the cash.
Oh yeah, I'm busy.
Present value of the cash flows minus the investment. If I'm going to get the IRR, still the same. I'll get the total to do the issue. So that one is going to come in any later stage. At any stage, you can add the investment, the incremental investment. Is it okay?
So it means even for that residual value, is it incremental and working capital?
You are saying?
After net income, we have residual value.
Residual value
Is it residual incremental value?
Incremental residual value.
Another question.
Yes.
On a residual value, on incremental working capital, are we going to subtract or to add?
Which one?
After net income, we have residual value. We are going to add working capital.
Working capital depends. Can be plus, can be minus. I don't know how I can put it, because it's going to depend on whether the working capital is increasing or is reducing. Can be plus, can be minus. Is the working capital increasing or decreasing? If the working capital is going to decrease, you're going to have a plus. If it is increasing, you'll have a minus.
Okay.
Yes. I first want to give a simple example, then we look at that question of 2021. Such that you will have, I think you can even do it yourself after this. think I've repeated this.
I think there is some word missing on a third sentence.
With expected residual value of 20 million at the end and depreciated over useful life.
Is it a continuity of the sentence number 3, number 2?
Yeah, it is a continuity. Don't know if I've captured all the information. Sorry. Let's go through the question together and see. And then from here, we can start, look at the other question I was telling you. Company X is evaluating replacing an existing machine with a new machine. The old machine was purchased 5 years ago at 100 million with a useful life of 10 years, with expected residual value of 20 million at the end, depreciated over useful life, meaning you are depreciating on set life. The current operating cost of the old machine is 15 million per year. The management are evaluating replacing the old machine with the new machine. I think that's a repetition. The purchase cost of the machine, of the new machine, should be the purchase cost of a new machine. Of a new machine is 180 million. Training cost of employees to use the machine is 5 million, and the installation cost of the machine is 15 million. The new machine has got a useful life of 5 years and a residual value of 30 at the end. The machine will depreciate on a certain basis over the useful life. Due to high capacity of the new machine, the operating cost is expected to decrease to 8 million per year. Furthermore, the new machine is expected to increase the revenues by 15 million per year. And these are the current, this is the current market value of the old machine. So advise the management on whether the old machine should be replaced by the new machine. So this is what we are having now. So what do we need? So what we need is the cost of the old machine. If you look at the data first, our data.
Can you give us 2 minutes to copy?
Okay. Hmm? Hmm. Can we start?
Yes, we can start.
So now cost of ownership is 100 million. We're going to reduce 3 zeros. Then our residual value of the old machine is 20. So it means useful life of the old machine is 10 years. So meaning depreciation of the old machine, the annual depreciation or the annual depreciation of the old machine will be, if I get it, this minus this minus the residual divided by 10. That's the annual depreciation. So accumulated will be the SEC depreciation of the old machine. Will be the annual depreciation of 8,000 times the period the machine has worked, because it has worked 5 years, times 5, which becomes, I think, 40. Which is 40. Now, that's the current accumulated. That's the current book value, the old machine. Current book value of old machine. Old machine. I think it's going to be the cost minus the accumulated. I get the current book value of the old machine. And the question gave us, maybe what I've not added, maybe you can add it. The corporate tax is 30%. I've not added that. The corporate tax is 30%. So market value of the old machine is value of old machine. The market value of the old machine is given as 45. This is the current book value. This is the current market value of the old machine. So it means in this case, we are going to have a loss. A loss on the disposal, which is this minus this. That is the loss. Having a loss, it means we shall have a tax saving on the old machine. A tax saving of 30% times 15. That's the tax saving on the old machine times 30%. Now, we can have the new machine. The purchase cost, we're looking at the new machine now. Our new machine. The purchase cost, they have told us is 180. We have training costs, because you add other related costs, get the cost. We have the training costs. Training costs to use the machine of 5. We have installation costs. Installation costs of 15. And it means our cost, the cost of the new machine is this plus this plus this. That's the cost of the new machine. Useful life of the new machine, is 5 years. So it means our annual depreciation for the new machine will be residual value. I'm not putting the residual value. Maybe I can write it here. Residual value of a new machine. The residual value of a new machine is 30. So meaning our annual depreciation will be the cost minus the residual value, then divided by the useful life. That is the annual depreciation for the new machine. Now, so if you look at this, now we can start our working one. These were data as I was summarizing, which we have also calculated some. Our working one is the incremental investment cost. And I have cost of the new machine, which is given as, which we have already calculated as 200. Then I less book value. So the market value to book value. Market value of all the machine. The market value of all the machine, I think we already calculated it when they summarized it up here, which is 45. We also have a tax saving.
Calculated the way the annual depreciation of for the new machine.
You are saying?
No calculation of the annual depreciation of a new machine. Is it well calculated?
You can look at it. It is 200 minus 30 divided by 5.
Yes.
You get what?
Let me check. It is I have the problem.
Okay, let's tax saving. So what is the tax saving? We have already calculated it up there, which is this. So our incremental investment cost will be that. That's the incremental investment cost. Now, we also consider working number 2, incremental depreciation. Incremental depreciation. So we have depreciation of the new machine. Of a new machine, which is this one. Then we have depreciation of all the machine. Annual depreciation of all the machine. We go to what? 8. So our incremental will be incremental depreciation. So I just get this minus this. That is working number 2. Working number 3. Working 3. We have incremental residual value. Incremental residual value. So which we are going to have as residual value of new machine, which is given as 30, I think, which is 30. Oh, I forgot to add something on working capital. Let's leave that. We shall look at it in another maybe question. I forgot to add that information on working capital. Then I have residual value of all the machine. Which is?
Excuse me, sir.
Yes.
I have a question on this, on the cost of machine. Cost of new machine. There are some details that they normally put there, which should not be included in the cost of machine.
Like what?
Like testing. Is it testing?
No,
I want you to help us. I want you to help us to know. You know, that part is somewhere how
do you determine the cost of an asset as per the IS 16?
You get the purchase cost and
plus
you add the related
costs to make the asset to work.
Yes.
Like what? Training of employees on how to use the asset is included. Installation cost is included.
Yes.
So what have I put that is not there?
I'm not saying that you did not put what was not there. I wanted you to tell us. There is a question that I don't remember that I saw. it had a lot of things which was there to confuse us on the cost of new machine. Maybe it is that question that will solve, but no things that they normally put there.
Okay.
Like the testing.
Okay. The testing, but testing is not included in as per IS 16 before the asset is going to be used. Those are installations. Yeah.
Okay. Well, no problem. Let's continue.
Okay. So increment. Incremental residual value will be so working number 4. We're going to look at incremental other cash flows. And we have our new machine. And we have the old machine. Then the incremental. So if you look at our question, we were talked about the operating costs. I didn't cover them in our operating costs. They told the operating cost of the new machine will be 8. The operating cost of the old machine is 15. So we have a decrease of this minus this, which is a saving in operating costs. Then they told us again, but you can take it as a positive, I think. Okay, let's make it a positive. We have an increase in revenues. Increase in revenues. We have not been given the revenue of the old, but they told us the increase in revenues is going to be 15, I think. The increase in revenue is 15. So our incremental revenues would be 15. Unfortunately, I forgot to add an information on on working capital, but okay, you can know how to adjust the working capital. So that is be the incremental income. Incremental incomes. Yes, please.
The operating costs for the old machine is 15,000, and the operating cost for the new machine will be 80,000.
The operating, yeah, it's 8,000. So what is the incremental?
Is it an increase?
No, it's not an increase.
Yes, the new machine.
It's a decrease, but it's an income. Because your operating costs are reduced.
The incremental will be...
No, that is my network, or it's
no,
network.
I don't know the appropriate term. Okay.
Incremental does not mean that you are only looking at the increase. Incremental means decrease or increase? I accept it is a decrease in operating cost of 5. That's why in the first we had a negative, but because I wanted to add them here, that's why I've removed the negative sign.
Okay.
Yes. Now, we can now get our net cash flows. Please mute. Olive. We are going for our net cash flows. Our net cash. Please mute your microphone. Now, let's look at our net cash flows. First, I think we have finished all the workings. We have our incremental, income, which is working in number 4.
Sorry, sir.
Yes.
If, for example, the increment was of sign plus, I have the new machine have the 80,000 and the old machine have 50. Then it means the sign could be minus.
Could be minus, yes.
Yes, minus and the 50 could be 80 incremental in income. Why it becomes 22?
Because our operating costs have reduced, it is an income.
Okay.
Yeah.
If the increase, it becomes the expense.
An expense, yes. So it means should reduce as your other incomes.
Okay.
So my incremental income, I have it, which is this. Now, what we do here, since our cash flows are going to be constant, we are going to less depreciation. My depreciation incremental, let me add the word incremental. Incremental depreciation, which is working in number 2. Which is this. What I get here is a loss of this. I get a loss of 4,000. Now, after this getting a loss, since I have a loss, I'm going to have a tax saving on loss. I don't have a tax payment. I'll have a tax saving on loss. Of course, at 30%. I'm not calculating the tax payment because I have a loss. It is a tax saving, which is going to be this times 30%. I have this. Then it means my earnings after tax, if it was an income, I would have calculated tax payment. But since it is a loss, I only have to calculate a tax saving. So know how to play with your data. I get this. Then I add back depreciation. Add back a depreciation, which is this. So my net income will be that. That's the net income. Now I can make this in a simple terms that can be easily understood. So I can say I have the item here. I have the period. I need to copy a bit down. I have the period. I want to make it in a simple terms. I have the cash flow. I have the discounting factor. Then I have the present value. Period is, I have incremental investment cost. Incremental investment, which is in period 0. And I can take my cash flows, which I calculated in working number 1. Where is it? Working 1 is here. Then I have incremental income. Incremental net income, which is from period 1 to 5, which I've calculated as 23. Then I have incremental residual value, which will be in period 5, which we got as incremental residual value. We got 10. So what's the discounting factor? Is 10. We're using 10%. Is it 10%? Our cost of capital. Did I give you the cost of capital?
Yes, sir. It is 10%.
10%. So our cost of capital is 10%. So it means period 0, it will be 1 plus 0.1 power minus 0. Here it's going to be, because it is annuity, 1 minus 1 plus 0.1 power minus 5, then divided by 0.1. Because I'm dealing with an annuity. Here, it's not an annuity, it is a lump sum. It's going to be 1.
Sorry, sir.
Yes.
The cost of capital is not given. I can see that it is for 10% is for the first question that
Let's
we
assume it is
did.
a 10%. Remember, I'm going to add that information. The cost of capital is 10%. I'm going to add
Okay.
Okay. Power minus 5. So the present value It will be this time with this. Here, this time with this. Then here, this time with this. So if you are to get the NPV, our NPV, you're using the NPV rule to evaluate this decision. Automatically, you're going to reject. The old machine should not be replaced. If you look at the if you're using the NPV rule, the old machine should not be replaced. So you are rejecting the decision. But I need to add that information. The old machine should not be replaced, since the NPV is negative. So you shouldn't replace the old machine with the new machine because you are going to make more loss. But I need to add that information in the question because it's not there. That our cost of capital is 10%. And the cost of capital is 10%. You can add it if you have written the question. So that is how we do a replacement. I don't know if you have a question on this. Any question on how to make these adjustments? I can now copy the other question down here. We can go through it together and we see whether you can handle. Yeah, let us skip to the some pages are already missing there.
Doctor.
Yes.
Are we not taking a break?
I thought the first break is going to be after we have finished this, but we need to finish investment today.
Okay.
The whole investment must end today. We're still having 2 parts.
Okay.
Let's go through this question. I thought the first break is going to be after APV. And the APV is a very common question. Let's look at this question of August 2021, and it is question 1. MCM Limited is a company engaged in the pressing and the processing of sugar cane juice into refined sugar. For some time, the company has been considering replacement of their three existing machines. The production manager has learned from the professional newsletter on sugar for the availability of a new and large machine whose capacity is such that it can produce the same level of output per annum currently produced by 3 machines. Furthermore, the new machine would cut down the wastage of juice. That is a deduction reduction in juice during processing. If the old machines are not replaced, an overhaul would be immediately necessary in order to maintain them in operational condition. So this overall would cost, so that's an opportunity cost. Then if you go down, it says,
how is it an opportunity cost?
Because when you make an overhaul, when you don't, if you purchase a new machine, you'll have to that's for me how I'm interpreting it. Maybe I've interpreted it wrongly. If you don't replace the old machine, you'll have to incur that cost. But if you if you replace, you will save that money. That money will be saved. Is it what? How do you call it?
It is opportunity.
That's what I'm thinking. Now, the following additional information is available. The old machine we have purchased 5 years ago, and we have the data on use old machine. Data on old machine. On old machines. Data on old machines. Useful life. Useful life is 5 years. 15, sorry. They have 15 years. And they are depreciated with estimated final scrap value of 600 for each machine. Remember, there are 3 machines. So residual value will be 600 times 3. I've reduced to 3 zeros. 600 times 3. That's the residual value of the 3 machines. The current scanned market value of each machine, the current market value is 1 million times 3. That's the current market value of the 3 machines. The annual operating costs of existing machines, those are the operating costs. Maybe I will need them. I will need these operating costs because I need to put them somewhere. This is the old machine. Old machine. These are operating costs. I can put them up probably. Then I will copy down because the information is going to get fragmented and we may lose it. Operating costs. We have, I would have loved to put it different, but raw sugar cane, raw sugar cane. It has, operating cost on raw sugar cane is 60. Labor, 1 operator. It is 1,350. Then I have variable costs. it is 925. Maintenance, it is 2. And then I have the current depreciation. The depreciation of the asset. Fixed costs, we have the depreciation and fixed factory overheads. Depreciation is 75. These fixed factory overheads, I don't know whether we are going to, so it's going to be 75. You have reduced 3 zeros, I think. I may not take this fixed offer. Let me first go down. Maybe I can take them, or I may not take them. If they are fixed, then we may not take them, unless they are going to be changing. Now, if you go for the new machine, has estimated life of 10 years. If you look at the new machine, the new machine, useful life, is 10. And then purchase price value. Purchase price value is 4.5. The purchase price value in 10 years.
On all the machines, are we going to add the depreciation on the fixed factory overhead?
Huh?
On the fixed costs?
Since they are fixed, I've left them out, but I want to see the other cost down, then I will see how to handle. I will see if they are incremental or they are not incremental. That's what I want to see before I add them. The machine has estimated life of 10 years. Initial cost will comprise the initial cost of the machine. Initial cost is 100 million. Then if you look at that's why I wanted to make this one. The operating cost. Can I say this is old? Then I put there new. And I copy the same data down here.
No, but lecturer, you should remove also depreciation. You should also remove depreciation because depreciation is under fixed cost.
Okay, but I wanted to use it, but okay, we shall look at how to handle it. So I wanted to summarize this data here, such that we can easily get the incremental. The sugar cane will increase. I cannot because it is, the information is this.
Well, what if you duplicate those information is on a new machine?
On down here?
Yes.
Yeah, I think it's better. Otherwise, the head had blocked. It couldn't think anymore. So, sugarcane, we're going to increase by 162. This is labor is increasing by is increasing to 3,900. Whether I didn't read whether this was for one machine. Okay, I need to check that up there. Whether I need to multiply by 3. Because these are 3 machines. Then variable costs, they become 275. Maintenance would be 4.5. We said we are first ignoring the fixed costs. Can we check these ones? I want to see here something. The annual for each, it's for each machine. So I have to multiply by 3 because it is for each machine. Times 3. The cache is blocked. I don't know if I will remember this. Now, if you go down here, I want to check this fixed overhead costs. We have fixed factory overhead costs. But if you look at this, these fixed factory overhead costs are changing. Let me see fixed overhead cost. Here we had 2.7 times 3. 2.7 times 3. It was 81. And here it's going to be 78. So it means this one is not fixed for factory. It is going to change based on the machine. Two, 7, 2, 7
times 3.
times 3. Okay. Now which other data we have?
Where do you get that 6,000 for maintenance? All the machine.
Because it is each machine. These costs are for each machine. That's what the question has said. So it means I have to multiply by 3 for each cost.
Oh, okay.
Yes.
But also we need to change on the data given all the machine.
For the old machine?
Yeah, up there. Yes, there.
Yeah, I multiplied by 3.
No. On operating costs.
That's what this is the one I've copied down.
Oh, okay.
So now, if you look at this, the company's cost of capital is given. Then what number 6 says, the project to be implemented must first be cost of capital as indicated by- Please mute. But its internal rate of return and the financial viability test in that it must pay back within maximum period of 5 years. Then they have told us to ignore taxation. Since we are ignoring taxation, we don't need a tax saving on the other data. So can we start now? Our workings. Working one, we are discussing incremental investment cost. So we have the cost of a new machine, which is 100. Then we recognize an opportunity cost of replacing, which is 5. And I think we get 105. Now, what is the current market value? Yes.
Excuse me.
Yes.
I don't understand how opportunity cost of not replacing the machine will be in the incremental investment costs.
So, if you are to replace the machine, how much will you incur?
The 100,000. I mean the cost of new machine.
If you are to replace, if you don't replace the machine, how much will you incur?
This 5 million.
So, what will be the cost to replace?
The cost to replace will be the cost of buying new machine. Of buying new machine.
Only, what about the 5 million? Where are you going to put it?
I don't understand.
Maybe I'm the one interpreting it wrongly. Let's go back to the data. Maybe I'm the one interpreting it wrongly. Maybe the one making a mistake. For me, I'm seeing as if it is going to increase our cost. The production manager has learned from professional news rate of that. That one is not. If the old machines are not replaced, you'll have to make an overhaul. So is it going to be a saving, an additional cost? That's the challenge I'm facing now. If you decide to replace the machine,
if it's not replaced,
if you don't
incur
replace it.
Yes, if it's not replaced, it will incur additional cost of 5 million.
So if you replace,
yes. If you replace, then we shall need the new machine of 1 million.
So what about this 5 million? Is it going to be an additional cost or a saving for replacing the machine?
You see, if we replace it, we are not going to incur this 5 million.
Yes, I concur. If we replace the asset, we are not going to incur the 5 million.
Yes.
It means you will receive.
Take it as, yes.
You receive the 5 million.
Yes.
Yes, I may accept, but if the machines are to be replaced, you will pay the 100 million, but recognize the saving of 5 million.
which in turn will reduce the cost, which is going to reduce instead of increasing this cost. Yes. Thank you.
Yes. Then since we don't have tax, we are not going to calculate the tax saving. Hey, we have still we have the market value. We have already got that. The market value, we have already got 3 million, I think. The current market value of the 3 machines is 3 million. So we are going to have how much? 92. Now, if you go to the incremental depreciation, working number 2. Incremental depreciation. What's the depreciation? Depreciation of the new machine. Depreciation of the new machine, they have given us as 7.955. 9?
Lecturer.
Yes.
My question is about why do you include in the investment costs these opportunity costs?
Over? Now.
For me, it looks like an operating cost or an operating advantage benefit.
That's why I'll put a negative. But I need to, really, I need to, for me, I see, the way I'm looking at it, but this is not my question. The way I'm looking at it, you have an existing machine which are operating. If you don't replace these machines, you are going to incur. You are going to make an overhaul, and the overhaul cost is 5 million. If you don't replace them, you are going to make an overhaul of the machines. So what will be the cost? That is going to be a cost of the old machines to make an overhaul. But if you decide to replace, you're not going to incur this cost. So will our purchase cost increase or decrease? That's, I think, where we're having an issue. Will the purchase cost increase or decrease?
The purchase cost will not be affected, but we shall simply save this 5 million, which we are going to spend.
Which we are going to spend.
Yes.
That's I concur with you on that. Okay, we shall look at it, but that's information that is a bit challenging and they can make us fail. So depreciation of old machine is going to be 750 times 3. $750 times 3. Then our incremental will be incremental minus this. Then you can recognize the incremental residual value. That is working in number 4. incremental residual value, which is going to have the residual value of the new asset which is, they have told us 4.5, the residual value of the new asset. It is 4.5. It is here. Value in 10 years. $4.5.
That is working number 3, not number 4.
Yeah, number 3. Then value, residual value of all the asset. Residual value of all the asset. I think we calculated it. It was 60. Residual value of all the asset. It is 180. So, and I get our incremental, get this, minus this. I think then what we need is the incremental operating costs as a working number 4. Incremental operating costs. I'm just going to copy the other data that we had already summarized here for incremental operating cost. This is our new machine, like this. So what is the incremental here? Incremental for sugarcane, we have this minus this. For labor, shall have this minus this. This will be this minus this. Still, all this we are saving. There's nowhere we are incurring additional costs. Minus this. We are going to make a saving of how much? Okay, I think we have everything. We can now start our net cash flows. Maybe that's going to be work number 5. Net. My still, I think I have not interpreted the other information well. Net cash flows. Now, we have incremental working capital. Incremental operating cost. With, which is this? Less depreciation. Our increment, of course. Incremental depreciation, we calculated it as but remember, we don't have tax. So you are going to add back the same depreciation. This is earning before tax. So add back. You could as well ignore depreciation since there is no tax. But for max, you can do these workings. but you could as well ignore it since you don't have tax. Add back a depreciation. Now that is the net cash flows we have. Net cash inflow. Now what we need now is to evaluate. Once I have the cash flows, I can evaluate. I have the item, I have the period, I have the cash flow, I have the discounting factor, which is what? The discounting factor in the question is what? Hey, I've already removed it. %, eh? Discounting factor at 10%. Then I have the present value. So investment, please make this one, try to make, I'm not convinced, I don't know why. At this point, I'm thinking that we are making a mistake somewhere in this. We are getting 92. Is it 92?
Yes. Yes.
Our net cash in. Our net cash. Remember, we are from period 1 to 10. From period 1 to period 10, we have got this. We have incremental residual value. In period 10, we got I think it is this one. Sorry. So this will be 1 plus 0.1 power minus this. This will be 1.
Excuse me, sir.
Yes.
The mistake is on depreciation. On the old machine, we have only 75,000 times 3.
I took a wrong figure.
Then on the new machine, it's a big number.
Okay, let me, okay, I'm going to correct. Let me calculate this.
Yes.
Plus 0.1 power minus 10 divided by 0.1. Where? Huh? Is 1 minus okay. I copied the wrong figure, it seems, for this incremental depreciation. Isn't it this? It is this 955 to 250. Can you check your incremental depreciation?
So on new machine, it's 9,550,000. Then on the old machine,
It's
it's
75
only
times
75 times 3.
3.
So if you reduce, you remain with 9,325.
75 times 3.
Yes.
You get what?
Look at the answer.
No,
The answer
what do you
should
get?
be
75 times. What do you get
9,325.
75 times 3? I want to first get the answer, that one. 75 times 3. What do you get? Put on your calculator.
250.
2? Isn't it
Can we
correct?
check on the
Remove 0. It is 225.
yes, it is 225.
Yes.
No 50.
No.
Unless if it is per one machine, it is 75.
It is 75.
You can check on the data. If it is 75, it is 225.
Okay. I think it is 75. We should remove 3 zeros.
Yeah, it is 225.
Here. Okay. I think it's now going to be automatic down here. But our cash in is not affected, eh? Our net cash flow. And what do you have here? It is 1 plus 0.1 power minus 10. So what is our PV? This times this. So if you add here, you have this. But remember, the question required us to get IRR, to evaluate this decision using IRR. That's what the question required us. Did it give us a clue on what to use as discounting factor? They want us to use 10 to 20. It means my next part is going to be 20. Please, whenever you are given this one, don't put your own. They told us to use 10 and 20. So I'm using 10, then I have a positive. Let me see the 20. Don't create yours once the question has given you the rates to use. So I'm going to copy this. Ooh. I'm copying this here. It has moved away. How can I copy it with the formula? If I copy it here, it is not coming out. The formulas are moving away. Fx, this one, but it doesn't take the formula. Eh? So just copy the formula. So it is not. Ooh. I think it is. I see no formula. Nothing to do. Does not copy the formula.
It is right.
Huh? The good I have the cash flows, I can maybe copy the formulas. Ah, wow. I've destroyed everything. What I needed, this one has not changed. I'm not changing this. But this one, I have to put a new formula. I'm changing this one to 20%. Oh. At 20%. So, but you can read this in your table. 1 minus 1 plus 0.2 power minus 10 divided by 0.2. Then here I have this plus 0.2 power minus 10. Now we can interpret our IRR. Since we have the positive and the negative. So our IRR will be equal to 10% or 0.1 plus 34, I can say 34, if you can put a bracket, 34, 697, 0.2 plus 0.1 over 34, 697 plus minus becomes a plus, 5, 828. What have I done? Can you get me the answer now? Please don't take a lot of time.
It's 18.56.
$18.56. Now, since our IRR is above, the project should be accepted. The asset should be replaced. Since the IRR is above the target cost of capital, the old asset or the old machines should be replaced by the new machines. I think that way. I don't know if you have a question, but I would like to copy this data down because they are fragmented. Any question?
We want to see the conclusion.
Okay, I'm copying it to where we are working from. Okay. So this is the first part, which is about replacement. I don't know if you have a question. And or we don't. When should we have a break? But remember, we have to finish investment today. Tomorrow we start something new.
I take a break now, sir.
And we come back at what time?
After 40 minutes.
At 1.
At 1. Now in Uganda, it means that. Okay. Okay, now when we come back, we are going to look at the adjusted present value.
But I wish we would take a break after 30 minutes.
No, take a heavy break first, yeah? After 30 minutes? The consensus. So what did you take?
Can we complete this
take it now?
the present value? We take break after present value.
We take a break after this one.
No, it's
Yes.
a very
No,
long.
we are tired, sir.
We are tired. Let's have a break.
We should have a break and we will be back after 40 minutes.
You know, always give ladies the first alternative, the first choice. And I think I'm
Yes.
hearing the majority of ladies are saying they are tired.
Yes.
We concur.
Eh?
Yes.
No, we are not tired, but we are hungry.
We're hungry.
The majority is the voice of God.
Please take a heavy breakfast. When we come back, oh, it is heavy lunch now.
Hey,
Mix
So
the
we
two.
come
then
back.
we shall be back when
No,
we
we
will
are coming
be
back
fresh.
at 1. at 1 because we needed to finish it.
Yes. Yes.
Yes.
Because there is a member
Exactly.
who has another class, and we need to allow him at 4 to go. At 4 we finish.
Lecturer, at 1 is too short.
No, for 30 minutes you can. I'm also going to eat something within 30 minutes, and I'm going to cook. 30 minutes
is enough.
30 minutes is enough to
30
prepare
minutes is
something. Yeah, 30 minutes. Okay.
But excuse me, sir.
Yes.
Before we go to APV,
Mm.
you haven't told about simulation
Simulation in risk.
in investment appraisal.
In risk. That is in a risk.
It's in risk.
Yeah, incorporating risk.
Okay.
But we were confused on that because we were not able to differentiate the risk and uncertainty.
That one is maybe what you look at the sensitivity. I didn't talk about this. I didn't even explain the word simulation. This was
You didn't. There is no simulation
because what I
there.
said, there is no calculation that are given here. What we need is the. I didn't explain it. There is no one word simulation.
But what I'm asking, we don't know whether there is technique of appraising investment under uncertainty and other
Under
technique for
uncertainties, you are taking me to your management account. I mean, performance management. Me, I don't want to go there. To look at this, the maximum, what minimax, because those are the one we use in a decision.
So in the corporate,
the minimax, the maximum. No, we don't go there. We want to look at these risks.
So in corporate, we mix them.
Yeah, we don't go into the minimax, the maximum, because that's where you are putting in the uncertainties.
Okay.
Yeah. Simulation, I said, in a simulation, the whole of variables are combined together, and you simulate them to see how they affect your NPV, but combining the whole of variables together. Maybe I didn't write, but I only explained it here. I think that's what we do in simulation. We will combine all the variables together and see how they have an impact the NPV. But we use computer software to do the simulation. Okay, I think we can have now this break, and after break we are going to discuss APV, which is very common question.
Let's copy the note you put on simulation.
It's a very common question. Please ensure that you get it. So let's have a break, then we'll come back at 1 for 1 and 5 minutes because you have consumed 5 minutes.
STO bite se? Meze neza. Aha, ndimo ngiye kukoherereza fayiro irimo ibyo bintu byose, ariko ikintu nshaka ndashaka ko printinga ari impapuro zitambitse. Donc kakaba ari agatabo gatambitse gatoya kabisa, kuko ibitabo binini kubitwara muri examen biravunana kandi binatwara okay, ubwo ngubwo kanze mbikoherereza kubera ntabwo nimugoroba byakunda, kandi ubu nanze kuguhamagara mu gitondo mvuga ngo wenda ngo wagiye ngo kwicaca. Aha ndahiye kabisa. Ejo se ko ari amatora ubwo uzabikora ute? Ayeye. Nta n'ibireka mbikoherereza. Yes, Fred. Ndakureba we mushuti wanjye. Yesu wanjye. Biri unmuted? Naba ndaburije mwana. Jesus.
Recording in progress.
So I think you are back, and we can continue with the APV.
Yes, sir.
So if you don't have question from our prior discussion, it was about replacement. I think we can start our APV. APV is a very common question in exam. Very common question in exam. So please try to get it. Now, when we talk about APV, it is just an investment appraisal technique, but an investment appraisal technique that considers the financing effect or the gearing, the financing effect of the project. That's what we mean by APV. So we can say that it is an investment appraisal technique that consider the effect of the financing effect of the project. So that what makes APV superior to NPV. That what makes the APV superior to NPV, because in NPV we don't look at how the project was financed, but in APV we now go into details to look at how the project was financed. So I think we shall look at the question. What is the question where they asked, what are the advantage of APV as compared to NPV? This is the main advantage of APV. That in APV, we look at how the project is financed. Because when you are going to finance a project using a debt, you are going to have a benefit of using a debt, as we saw in Morgan and benefits. So we look at that effect of debt financing on the project. So what are the steps in APV? Steps in APV. The first step, or step number one, appraise the cash flows or determine the present value of or equity, or define the present value of an GRD business. Determine the present value of an GRD business. You're going to determine the present value of an GRD business. Now, what you need here, the cash flows may be the same, but what you need here is to discount the cash flows using the cost of an GRD business. That is, discount the cash flows using the cost of equity of an GRD. The cost of equity of an GRD business. Get your cash flows, the same way we have been looking at that. Then after that, discount your cash flows using the cost of an GRD business. That is step number one. Step number two, consider the effect of debt finance on the cash flows. On the project. Consider the effect of debt financing on the project. Here, you have to go a bit into details in this aspect. So first, when you are looking at this, what I look at, we look at the interest on the debt as got a saving. First, look at the interest on the debt, or tax saving on the interest on the debt. Tax saving on the interest on the debt. That's the first. Look at the what is the saving on the interest of that debt. Now, the second aspect, look at if the debt is subsidized. If the debt is subsidized or part of the debt is subsidized, look at the interest saving on subsidized debt. Interest saving on subsidized debt. If the debt is subsidized, for example, you may find that part of the debt you are going to get at subsidized rate, and another part is at commercial rate. So look at the saving you are getting on that subsidized. How much are you getting on subsidized debt? Then another thing that we need to look at here is interest saving foregone on the subsidized debt. Interest saving foregone on the subsidized debt, because or tax saving on interest or tax saving. Sorry. Tax saving foregone on subsidized debt. That if you have got a debt, for example, if you are going to finance a project with 100 million, and maybe 50% of the debt is market. Sorry, is market maybe at 15%. Let's assume that. Then another 50%, you are getting it from the government. Another 50% of the debt, you are getting it from the government at 8%. So it means in this case, if I'm financing this, part of my interest, I'm going to calculate it at 15%. But by taking this, I'm foregoing a tax saving of 7%. So I recognize that as my opportunity cost. I hope you have got me on that side, on that issue.
Not clear, please.
We are saying you are getting the financing of 100 million or 100 million. But this loan is going to be 50% market. 50% is going to be market or commercial rate at 15%. This is the commercial. And another this loan is subsidized from the government, and the interest is 8%. What does it mean? It means if I take this loan at 8%, I'm going to forego a tax saving at the rate of 7%. You're going to forego a tax saving which is at the rate of 7%, which should be recognized. That's what I was saying. We shall look at that maybe when we're looking at an example. Another thing that we need to look at in this is the issue cost. The issue cost can be on equity, the issue cost can be on the debt. What is the issue cost? Now, when you are analyzing the issue cost, there are two things that you need to look at. When you're analyzing the issue costs, there are two things that you need to look at. Sometimes the issue cost can attract tax, but not always. Other time, the issue cost may not attract.
Ntabwo tukumva.
I'm saying the issue cost sometimes can attract tax, sometimes may not attract tax. If the issue cost attract tax, it means you're going to have a benefit on that issue cost. If the issue cost does not attract tax, then you're only recognizing the cost of the issuing the debt. Now, what you should be very careful when you're analyzing your issue cost is that if a project requires 100 million, you're analyzing the project requires 100 million. And maybe you're going to finance this project with a debt. Let's assume that. You're going to finance the project with a debt. And the issue cost on the debt maybe is 4%. Let's assume that. So this means the 100 million you are having is 96%. It's not 100%. So when you are computing your issue cost, you should know that the 100 million is not 100. It is 96. So you should get, when you're computing, in this case, your issue cost will be 4 over 96 times then the 100 million to get your issue cost. Because this one is only 96% of the money that you got from the bank. And when you are computing interest, you should get the net amount plus the issue cost. Compute your interest. Please be very careful when you are looking at that. Be very careful. So I said each cost can have tax or may not have tax. So if each cost attracts tax, the tax should be recognized as a benefit. So if your each costs are going to attract tax, then you're going to recognize the tax as a benefit. I mean the tax that benefit as which reduces the total amount of each cost. Now, then step number last, your APV. Compute the APV, which would be step 1 plus step 2. You'll get step 1 plus step 2, and then compute your APV. Not very complicated, but it requires you to be very careful. So there is a question that I want us to look at, which is here. There are two questions, in fact. I think there is this. Let's look at first this one, then we can look at another one, then we summarize this part. This is a question of 2023 April. Terimbere Company Limited is a listed company in the construction industry, which specializes in the construction of roads and bridges. TCL, or Terimbere, is considering a project that would involve an investment of 100 million. So this is our initial investment, or the data given. Data given. I have the initial investment. Which is 100 million. I'm going to reduce 3 zeros, which is 100 million. And that would involve.
But you put net of which cost?
Eh? I'm still
on that initial investment.
A
You
net
put
of
net of
it is net of each cost. Okay. I need to write it where? Here. Or we shall get it. But we shall get it from that. It's net of each cost. And our annual cash flow, annual cash inflow.
This is 2022. Which month?
2023, I think. April. I don't know if I copied the right
one.
Question 1. Annual cash flow is 55 million. For the next 3 N, our N or period is 3. Then that's the period. At this period, you have no scrap value. Our scrap value is 0. Scrap value is 0. Then they have told us the machine will attract written down value. Depreciation is 25%. %25% per annum on reducing balance, with balancing out at the end of the project, when the machine is scrapped, with a balancing allowance. We shall recognize the balancing allowance at the end of the project. Remember, the residual value is 0. Then we have an equity beta. Equity beta, which is 1.29. And because of the new investment, firms in the same industry have an average equity beta. Average equity beta which is BE, which is 1 point what? 1.24. Then firms, am I reading the same? I skipped one. An equity beta is this, and debt to equity is this. Then this is equity beta ratio, debt to equity ratio. Debt to equity ratio. The debt to equity ratio is The debt to equity ratio is 1 to 3. Though this will change because of the new investment. Firms in the same industry have an average equity bet of 1.4, which I've captured, and an average debt to equity of 1.2. This is we are taking the average. Average debt to equity, which is 1 to 2.3.
But you have changed.
Huh?
First, debt to equity ratio is the 1.1 to 3.
But because they are saying because of this, because of the change in the industry, the change of the debt to equity ratio is going to change it to 1 to 2.3. That's what they are saying.
We are not seeing where you are talking about.
Am I the one reading the wrong information?
Is indicated there.
No, they are saying that the
ratio will change. This ratio will change because of the new investment. This is the current ratio, but it's going to change because of the new investment.
Okay.
So, and they are saying farming in the same industry have an average equity of this, and an average debt to equity of this. So, because this is the current without that new business, but it's going to change to this. And it's going to change to this. Now, what else do we have? We have a risk-free rate, which is 5%. We have a market return, which is 9%. And the debt is risk-free. Okay? The corporate tax is payable in the same year at 30%. Our T is 30% in the same year. The debt beta is assumed to be 0 because it is risk-free. The new investment will be financed as follows. Debt is going to be redeemable in 3 years. It will be 30% times 100. And we get 30% times 100. That's the debt. Hope we are getting the data together. Equity is 70%.
Excuse me, sir.
We are lost, lecture.
Why do you times 100?
100 million, the total amount we need, 100,000.
Okay.
Where are you lost?
There.
Like that. Because that's the investment we need. Equity, they are telling us it's going to be 70%. You are lost? So if you multiply this,
we are trying to check where is the debt of 100 million.
The total investment is 100. That's the money we need to finance the project.
First paragraph.
We need 100 million to finance the project.
Yes.
And this is
then why are you multiplying by 30%?
You look at this data here. The new investment will be financed as follows. Debt redeemable in 3 years, 30%. And the equity 70%.
Okay.
You have seen it? So that is it. Then each cost at 4% on gross equity. Each cost at 4% on gross equity and 2% on the gross debt. Remember, these figures are net. So what is the each cost on equity? Each cost on equity will be 4/96. Isn't it? Times 70. That will be the each cost. It is 4/96 times 70. That's the each cost on equity. And what's the each cost on debt? The each cost on debt is 2%. So it is going to be 2/98. Then times 30. So it's going to be 2 divided by 98 times 30.
Excuse me, Doctor.
Yes, please, Wilson.
I can see this.
Huh? I'm not, is it my microphone? But I'm not hearing you well.
Nashaka hano according to the net.
I've not got you well, Wilson, but you can send the question in the message. I can read it.
You cannot hear me now.
I can hear you well now.
Okay. I was saying, why are we getting 4/96 and 2 out of 98?
Because these values are net. They are net. They are not 100%, but they are net. It means for debt, it is 96%.
Okay.
Debt is 98% because the each cost is 2%. Equity is 96% because the each cost is 4%.
Here they are gross and you are netting them.
Yes.
Okay, thank you.
Lecturer.
Yes.
I can see on the requirement that they have asked to calculate the APV. If in case they have only said evaluate the project and advise management whether to continue with the project. What can indicate us that we need to calculate the APV in this scenario?
As long as you are going to finance the project using debt and equity, the appropriate technique should be APV.
Okay.
Yes. So now I think what have they told us? Each cost are going to attract the tax. Any information on that? The corporate tax is payable in the same year at 30% of profit. But does it mean that the each cost are attracting tax? That one is a bit challenging. So our total each cost is it? You'll have this plus this. That's the total ish cost. So what is the now? Okay, we can now start our, remember our first step when you are using APV. These were just workings. The first step when you're using APV is to get the value of an geared business. That's the first step. What is the value of a business that is not geared? And how are you going to get that? You're going to get that value of an geared business by discounting your cash flows using the cost of an geared business. So basing on the data we have, automatically this tells us that we're going to use capital pricing model. Because you have a risk free, we have a beta, we have a market return. Automatically that tells you you're going to get the cost of using. That means my KU, cost of an year, will be the risk free rate plus asset beta into market return minus risk free rate. But if you check in the data, we are only given an equity beta. We are not given an asset beta. In the data you have equity beta. So it means I have to use that information to get an asset beta. And how am I going to get an asset beta? My asset beta will be equal to VE times VE. That's the equity beta. VE plus VD into 1, sorry, minus tax 0.3 or minus T. Now, since I have this, I can substitute to get my asset beta. Because in this case, but I'm going to use the average. That reflects what is current in the market. So I'm going to use the current average equity beta and the current debt equity ratio after financing the business. So in this case, our asset beta.
Let us understand where the reason why we are going to use an average.
Yes.
Help us to understand the reason, the logic behind using average.
The reason we are going to use the average, the question told us that after financing the project, these ratios that we had previously are going to change. Although they have not given us the change, but they have told us the average, what is in the industry, where the company is operating. That's why we are benchmarking the industry.
Is it maybe because the project to undertake is going to be to fit in that industry in terms of risk?
Probably.
Okay.
So it means I'm going to take my VE, which is 2.0, which is, because this is debt to equity, it means VE is 2.3. 2.3 times 1.24 over 2.3 plus 1 into 1 minus 0.3. What do you get?
Where do you get 2.3?
What's this ratio? 1 to 2.3.
Okay.
Is the value of equity 2.3?
This is debt to equity. It means debt is 1, equity is 2.3. Isn't it like that? Maybe I'm the one who
Yes.
The
Yeah,
value?
it is correct.
What's the value of equity there in that ratio?
2.3. The reason why we are confused is we were expected to calculate the value of equity, but that one is a ratio, just a ratio. Okay.
Maybe I'm the one interpreting it wrongly, but I think.
No, you are correct. But for us, we were not expecting that we are going to use the equity ratio, the debt equity ratio. We were expecting that we are going to calculate the value of equity, the value of debt, and you compute. Okay, but you are right.
Okay. And you are getting what?
It is 0.951.
You are getting?
0.951.
0.951.
It's better we stop on the 2 decimals. 0.595.
Okay. So now since I have the asset beta, I think I can get my cost of ungeared. The cost of ungeared will be equal to our risk-free rate is what? From our summary, 5%, and they have 9% market return. Is it true?
Yes.
Did I copy well?
Is it correct? Risk-free rate is 5. Market return is 9.
Is 9. Okay. So 0.05 plus 0.95 into 0.09 minus 0.05. And you get what?
For me, I get 8.8%.
8?
0.8%.
0.8%. That's the cost of an GRD business. And it is the one that we should use to discount our cash flow, to get the value of an GRD. They told us the cash flows are constant. Isn't it? These cash flows are constant. They are annual cash flows every year. They are constant. And we don't have a residual value at the end. So it means what's going to be the present value of these cash flows? The present value of cash flows. Hey, there is a tax. Oh, there is a tax. We need to get working number 2. The tax saving. This is our period depreciation, net book value, then the tax saving. Period 1, period 2, period 3. So our cost of the asset is 100. So it means in year 1, depreciation is going to be?
That is tax saving on what?
Huh? On asset.
That is an asset.
Yes, hey, I think I should make it clear. Tax allowable depreciation. Let's make it like that. Tax allowable depreciation, which cost was taxi. So remember our cost is it? Our cost is 100. That's the cost of the asset. And the depreciation rate, 25%. So it means here, we are going to have 25% with the cost, which is 100. And your net book value will be this minus this. So here, we are calculating on this times 25%. So this and if you remember, they told us in the question, they told us the scrap value at the end is 0. And they told us to recognize a balancing allowance. It means our balancing allowance will be this. Are we there?
Yes, sir.
Yes.
Please elaborate on that.
Because in the question, they told us that the scrap value at the end of this is 0. But then they told us to recognize a balancing allowance at the end. So what would be the balancing allowance? It will going to be this value at the end of year 2. Yes, I've heard someone also asking.
Yes, why do we put it under depreciation?
Why? Because it's like a loss. That if the asset had a value of 56 at the end of year 2, then at the end of year 0, you have 0 value. then it means you'll have a loss of 56 at the end of your project. So we are calculating this at this time 30%. So that is what we have as our savings. I don't know if you have a question there.
What is the useful life of the asset?
They told us 3 years. Three
Always
years,
did not get
the scrap value, 0.
okay.
3 years and then 0 scrap value at the end of 3 years. So now we can get our NPV, value of ungeared business. Can have year 0, 1, year 2, year 3, year 3, because we are paying tax in the same period. Our cash inflow, now the question is, that's the challenge we have. Now that's where we can fail. These 55, have they already charged the tax? But because they gave us as cash inflows. Yes? Members?
Yeah, in the third year on that asset, we are going to calculate the tax saving on the depreciation of third year.
Can you repeat the question?
Your voice is not getting out.
I'm saying, can you repeat the question?
Yeah, I was asking whether in the third year we're going to calculate the tax saving on the 55,
Yeah,
56.
because it is a loss. It is a loss we are getting, so we're having a tax saving.
Okay.
Yes. My problem is coming on this one, on this 55. Because the question told us is a cash inflow. Have they already adjusted the tax on it or not yet? I'm going to charge a tax because the question is not make. Or since it is a cash inflows, we don't need to charge a tax on it. Then this is our earnings after tax. Then we have the tax saving. Here we have this. We have this. And we have this. Then our investment. Which is 100. So our net cash flows. net cash flows, we are going to have, I think here. Our discounting factor at 8.8, which is almost 9, eh? So in this case, 1 plus 0.88, eh? Then power minus this. So what will be the PV? Have this times this.
Doctor,
Yes, please.
the cash inflow is not going to change.
It's not going to?
To change. Each year I can see 55,000.
Yeah, they told us it's going to be 55 annual. Annual cash flow, they're 55. Yeah. So what are our present value of any PV of an yearly business? An will be, I'm going to add, that's what I get. Are we there together, friends?
Yes.
Done.
Yes, question.
Yes. Yes.
Yes. Please ask. Hello, please ask the question.
No question.
I had someone who wanted to ask, but probably has gone off. The next one. Yes. The next to get the debt tax benefit, or the benefits of debt. The debt tax benefits. Now, what's going to be the debt tax benefits? First, we need to get the gross amount of the debt. What's the gross amount of the debt? Remember our net amount of debt. Our net amount of debt was 30, when we calculated 30 million. Then we have an issue cost. We have an issue cost, which is how much? An issue cost of the debt, which is this one. So our gross is this. That's the gross amount of the debt. Are you there? Now, what is going to be the interest on this debt? Interest on the debt at 9%. So that's what was given in the question. It's going to be this times 9%. I think we get that. And what will be the tax saving on debt at 30%? We are getting this times 30%. I get that tax saving on the debt. Anything else we need to calculate?
Where is this 9% coming from?
Maybe I'm the one who got it wrongly. Let's go back. I saw as if it is the same, 9%. Look at here. Maybe I'm the one who misread it. The risk-free rate is 5%. Isn't it? Then the market return is 9%. And the debt is risk-free. It is 5%, not 9%. So we are using 5%, not 9%. Because the debt is risk-free, means we are using the 5% here as the interest on the debt. Is it okay? Or it's my interpretation?
Debt is free.
They said the risk-free rate is 5%. Is it okay? The market return is 9%. Is it okay? And,
Yes.
and the debt is risk-free, meaning it's a government bond, it is a treasury bill. So what is the interest on the debt?
It will be risk-free rate.
The risk-free rate will be the interest on the debt. So this is 5%. So I think we have finished everything based on the question we have. My worry, we are not told whether I'm not going to consider whether the each costs are adapting. Because the question has not told that. So it's a gamble in that.
If they did not say it, we will assume that we will not attract tax.
That's what we are assuming, that the debt is not attracting tax. There's no each cost. Tax on each cost. So now it means I'm now taking my, I'm to compute my APV. So I'm going to get the NPV of an GEAD. NPV and GEAD. We already got it as it.
I think it's better you say tax saving on interest.
Okay. NPV and GEAD, we have it. We have the tax saving on interest. which is this. Then we have each cost. Which we got as the each cost on the debt we got. This is why I added the total, which is this. So what is our APV? I don't know if you have a question on this. Yes? Any question, members, on this? You are not saying a word. What is wrong? I think that
For presentation purpose, can you go down again?
I'm copying this and then I copy to the where we are working from. Below the question, which can make it easy for you to read. That's where we are. So in that case, we accept the project should be taken. The project should be undertaken. Any question, members? You are not saying a word. You are keeping quiet.
Okay, question aside, it's the matter of doing so many questions so that we can.
Okay.
Yeah.
My question is about the issue cost. Is it because it is like it is issued at the year zero? That is why we are not discounting it.
Yes.
Issue cost.
Yeah, it is at year zero.
Okay.
Now we can look at another one question, I think.
Hello, sir.
Yes, please.
Excuse me.
Yes.
Before we move on, I want to ask on working number 2. For the tax allowable depreciation.
Yes.
I'm seeing that the tax savings is 10% of the net book value.
The tax
saving.
I don't want to take that assumption. I have been hearing even other students talking about that. Please, I don't want to take this assumption. Why don't you calculate it normally? What is wrong of calculating it normally? I don't want to take that assumption. Sometimes it can change. Yes, I hear people talking about it sometime like that. I've never proved it. I cannot give a comment on that. Now look at this one in the last year. What will you write? Is it 10%?
10% of what?
Because what they are looking at is some people are here on the net.
Your voice is not getting out where?
Oh, I don't know. Maybe I'm saying
Okay.
in some, I always hear it from student. For me, I've never read it somewhere. That's I can confess. I've never read it somewhere that tax saving.
We don't even understand the question.
Is saying that tax saving is calculated as 10% of the net book value. And I don't know where I don't know where the concept is coming from, but it's not always. That's what I can confess on my side. It is not always. For example, if you look here, it's true 10% here. Even here, true 10%. What about here? In the last year, you may end up messing it up. So my advice, you should calculate 30% on your depreciation base. On your depreciation. That's my advice. Don't take the 10%. Please calculate your saving on your depreciation base. Is it okay?
Okay, thank you.
Yes.
That's how even I wanted to know how we've got like 30% of depreciation. Yeah, thank you.
Okay. So any question, any other question on this? We are summarizing it. We are going to this other question. I forgot the paper. I don't know how the paper came out. Let me check back at the paper that I copied this question. I think it was this one. Yeah. It's November 2023. November 2023, still question number 1. This part is very common, very common, very common. APV is very common question asked. Please follow the steps, master the steps that you need to use to get your APV. It's a very common question. It cannot miss 2 sittings, it cannot miss more than 1 sitting without coming back. Let's look at this one again. Instant Power Limited is hydroelectric power plant with an impoundment facility.
Lecturer, that is for which year?
2023
which
November.
sitting?
2023 November.
Okay. Question, okay. That's the question number 1.
Question number 1. Instant Power Limited is a hydroelectric power plant with an impoundment facility. The company has established a project to build hydroelectric power plant in Bugesera. The company intends to purchase an initial crucial machinery for 100 million. So it means our IO is 100 million. If I'm capturing this data, is 100 million. The machine is expected to operate for 25 years, useful life. 25. And they get fully depreciated. Residual value. Residual value is 0. IPL predicts that it will earn earnings before interest and tax. Our EBIT is 14 per year for 25 years. This is per year for 25 years, the useful life, with effect from the end of the first year. With effect from the end of first year. Okay, end of the first year. So it's the same. The company pays corporate tax. Our T is 30%. The company's investor requires a return, a 12% rate of return for the projects under all equity financed. It means this is a KU because it's all equity financed. Our cost of ungeared is 12%. That's the cost of ungeared. Now, it says, and other equity financing and the pre-tax cost. Our KD, which is pre-tax, is 9.5. Because of the extent of the grid electricity is limited and mainly concentrated near the capital city, the government will subsidize the project with 50 million 20-year loan and interest rate of this. Subsidized loan is subsidized loan at 6% is 50. Then it means market loan at 9.5 is also 50. The government expand the capacity mix national project. The government has also allowed the to repay the principal in a single amount, in a single payment at the end of the loan. So the loan is going to be paid at the end. So it's not going to be making annual payment. I don't know whether the interest will be earned. The single payment of the principal. Not the interest will be paid, but the principal will be paid at the end. And what is required? Using appropriate calculation, estimate the adjusted present value of IPL. Proposed investment. Round your calculation to 2 decimal places. Then differentiate between APV and NPV as a method of investment. I think that one you can talk about it. Oh, my network is becoming low. So I think it's the same principle that we have been following. The good thing this time, yes.
Excuse me, sir.
Yes, please.
Where do you come with market loan at 9.25%? That 50 million.
Maybe I'm the one who have misinterpreted the question. Maybe let's go back. We are going to invest in a machinery 100 million.
Yeah.
And they have not told us that we are going to, they are saying the investment is going to be financed by, to invest it by debt, of which the government is paying, is giving us 50 million on that investment. So how much are you going to finance within the market loan?
Is it 50?
Is it 50?
Okay.
For me, I'm not seeing that.
Eh?
Where are you reading? Maybe I'm lost.
This is the money we require to invest in the machine.
Yes.
Is it okay?
Mm.
And how is it going to be financed?
Mm-hmm.
They said, and a pre-tax cost of debt is this. Because of the extent of the grid is made, the government will subsidize the project with a 20-year loan. Is it okay?
Yes.
With a 20-year loan at an interest of 6%. Maybe, so this is the government loan. What about the balance? Is going to be financed by what?
Make the value maybe.
But yes, maybe market value, but it's not showing us the loan value, the loan. That loan will be of how long?
That is the problem.
The market loan. Can we take them as 2020, the same period? That's the challenge we are facing for the market loan. Is it also 20 years or it's going to be 25 years? Okay, let's move on. Then we shall look at the data, the way it moves. Now, if you look at the data we are having, of course, we need the NPV of an GRD business. And if we need the NPV of an GRD business, automatically, we shall have to get the two things. We need to get the depreciation of the asset. Which is going to be the depreciation of the asset it is 100 minus 0 divided by 25. And we are going to get 100 divided by 25. That's the depreciation. And they have told us the asset will depreciate fully to 0 in the last year. And they have not told us that we are going to have a balancing allowance at the end. So what's going to be the tax saving on this depreciation? On depreciation. At 30%. That's the tax saving on the depreciation. So, what is going to be our net cash flows? Maybe working in number 2.
Have we been told that we are having a tax allowable depreciation?
No, it's not given, but they said from here. That's what I'm thinking, but it's not given. The machine is going to operate 25 years and they get fully depreciated.
Mm-hmm.
Is it okay?
Mm.
If IPA predicts that it will earn these earnings, so don't we need to calculate? They have given us a tax rate. Don't we need to calculate a tax saving on depreciation?
No, for me, I see we can calculate maybe the asset is not allowable depreciation.
Sure. Let's hear from others. For me, I'm thinking that because we have been given that asset is depreciating and is going to have a tax, there's a tax rate, we need to calculate this depreciation. Let's hear from others. What are you saying on this part? Or you check in the past paper in the solution.
No.
For me, I'm thinking that
I think
we are not
as long
depreciating.
as we have, hello?
Yes.
As long as we have tax rate and the depreciation,
we need to calculate the tax.
automatically tax saving, tax allowable is there.
Yes, that's also what I'm thinking, but maybe you can check the solution and see what the examiner wanted to say about that. Annual cash inflows. Because this is 25 years, we are not going to compete for up to 25. Since the cash flows are constant, we can get the annual. So our EBI DT, we said it is 14. Less tax. At 30%. This. And 30%. You have that. Then I have my EAT. Then I consider the tax saving. Tax saving, which is 1,200. Then my annual cash flows will be annual cash flows. Now, remember.
What is working number 1, lecturer?
Working number 1, we have calculated this tax allowable depreciation. Remember, these cash flows are annual every year, up to 25. So what, and our KU is given in the question, is 12%. That's the KU. So what is going to be our annuity factor? We need a present value, interest factor, annuity of 12%, period 25. Present value interest factor annuity, 12%, period 25. You get what? So I'm going to put in the formula 1 minus 1 plus 0.12 power minus 25 divided by 0.12. That's the annuity factor. They said 2 decimal points. So what will be the present value of the cash flows? I'll have this times this. I have this as my present value of the cash flows. My initial investment is 100. So the NPVU will be that. You can tell me if there's somewhere I've skipped. If there's an information I've skipped on this. Anything I've left out? Maybe we can call this one. Is it the annual cash, or we can call it the NPVU, because that's the last results. Then working in number 3, we need the present value of the debt tax. Present value of debt tax sheet. Present value of the debt tax sheet. Now, we have 2 loans that we need to look at this. We have a subsidized loan and we have a market loan. So if you look at our market loan, we are having our gross loan. Our gross loan is 50. That's the gross loan. Interest on the loan, interest at 9.5%. Will be this times 9.5%. Then our interest tax saving at I think we made a mistake in the other part. We didn't get the present value. We only calculated the interest. We didn't get the present value. I think we made a mistake somewhere there. Hey, did you get the present value? At 30%, we get this. Time was 30%. Now, what we need again here is the present value of the interest tax saving. Present value of interest tax saving. See, this is what I'm talking that we may not have put this interest tax saving. So what is our annuity factor in this case? Well, I can first get the annuity factor. That's where I have it. What is the annuity factor? We are going to use the same period, 20 years, because they have not told us the loan is going to be of how long. But the government loan is...
A question.
Yes.
I can see on this question, we are calculating the present value.
Yeah, that's what I said in the other question. We made a mistake. We didn't calculate the present value. We only took the interest saving,
Yes.
but we should take the present value, not the interest saving. So you can correct that. Or I will correct it in the year.
How should we get the present value? We should do also this.
Get the annuity factor. I think it is was. I'm going to make it correct it. It was here. It was here. I'll not add the annuity here. I can add the annuity factor. Because it is for 3 years. And our rate was how much? Is it 5%? And it was 1 minus 1 plus 0.05 power minus 3 divided by 0.05. Yeah, that's what it should take. The present value. We want to take for 1 year. It should be for the present value.
One year, why?
Hmm?
Why
3 years.
do
We should use 3 years, not 1 year. Because the years were 3.
Okay.
Yeah. So you can collect that.
Then you can write that is the present value of
Interest. Present value of interest tax saving. So our annuity factor, are we using 25 years? Because the project is 25 years. So we are going to use 25 years of the project. So it's going to be?
How much did you get?
why not 20?
20 is the loan, but the project is 25 years. The loan is not telling us how much the market loan is going to be given. So we are going to have the annuity factor 1 minus 1 plus 0.095 power minus 25 divided by 0.095. So that's two decimal points. Huh? So our present value of interest tax saving will be this times this. That is one. Now we have an interest saving on a subsidized loan. We have a subsidized loan. Our interest on subsidized loan, interest will be interest at percentage at 6%. We are getting subsidized loan is how much? Okay.
You mean gross amount, gross loan?
Yes. If also. Isn't it?
Yes.
Interest at 6%. We are getting this times 6%. Then tax saving at 30%. I have this times 30%. Then what's my annuity factor? My annuity factor will be one minus 1 plus 0.095. Now this one is a challenge. Are we using, because this one this one is 20 years, it's not 25 years. I think the information was not very clear there. We will cross check. This is 20 years.
Doctor, why are you using 9% instead of 6%?
That is good. Both market loan. This is mute. Both the market loan and the subsidized loan should be discounted using the same cost of capital. Does it make sense? Both the market loan and the subsidized loan should be discounted using the same cost of capital.
Is 9% the cost of capital, or it is the interest rate?
9.5, the market date. The market date.
Yes. So how should we consider this as a Cost of capital.
That's the same cost of debt. The cost of the market is the one which is considered as the cost of the debt. So when you are discounting, you should use the same cost of debt, which is the market interest rate.
If you use the risk-free rate
of it depends on the type of the debt. It depends on the type of the debt you are looking at.
No, the same scenario. Maybe they include the risk-free rate. If you use to discount this using the risk-free rate, is it a mistake?
But in the question, do you have a risk-free rate?
No.
So in that case, there's no way you're going to apply it. So what's the PV? We are getting this. I'm on this. Oh, we are rounding off too much, and they told us 2 decimal points.
So at this point, you have used the 20 years or 25.
I've used
for
the
annuity
20.
factor.
Is it 20 years? But I'm about to ask the lecturer why she didn't use the 25 years.
You know, the issue, I'm not using 25. Although the project time is 25. I agree. I'm not, but my worry is this debt is going to be paid in 20 years, not in 25 years. So yes, it is a challenge on how to match our cash flows. But how are you going to look at this? Should we use 25 years? Are you going to get this benefit for 25 years? Or the benefit is going to stop in 20 years? Are you getting my issue? Maybe I'm the one who's thinking so much. Because what we are recognizing is a benefit. Are you going to get this benefit in 25 years when the loan is paid in 20 years? Or the benefit will stop in 20 years? What do you think? Members, you are not saying a word. What do you say? Are you going to get the benefit for 25 or you're going to get the benefit for 20 years?
For 20 years, as they said that the
loan is paid in 20 years. That's what I'm thinking also.
That the loan will be paid in 20 years at an interest rate of 60% per year.
So that's what I'm thinking, but you can cross-check in how the examiner made it. But if it is me, there's no way I can accrue that for 25 years because the benefit for this loan is stopping in 20 years. The other one we have used 20 years because we assume that the benefit is going to accrue to 25 years when the loan will be paid. But if that loan they have told us that the loan will be paid in 20 years, it means the benefit will stop in 20 years. But you can cross-check and see. Maybe my approach may not okay. Maybe I interpreted it wrong what the examiner was thinking. But for me, that's how I see it. Now, we are also saving an interest. We have this. We have this. Interest saved on the market loan, subsidized loan. How much interest was saved on this subsidized loan? So our interest saved will be interest saving will be 9.5% minus 6%. Then times 50. I'm removing this. You'll remember that. Yeah? Which is going to be this times 3.5%. I get the interest which was saved. So in this one, I don't, because this is the saving I received on the interest. So it means in this case, our annuity factor, I'm going to copy this again. Because we are saving this interest for 20 years, not for 25 years. We are saving the interest for 20 years, not 25. That's for me how I interpret it, but you can also cross-check and verify my interpretation. So the present value of interest saved
is 175 only, not 1750
it is only 75.
on interest saving.
Present value of interest. Hey, how would I multiply?
I don't know.
Are you not multiplying by 50,000? It's 50,000. Can you cross check? This is 50. Can you cross check again?
Yeah, it's okay.
So I have this times this. Okay. Now what is missing? We are missing is one part. Tax foregone on interest saved. Tax foregone on interest saved. Tax foregone on interest saved. So our interest saved is this our tax on interest saved at 30% is this times 30%. Our annuity factor, we have the same. I take this. But please you cross check and see whether they are also using 25 or the examiner used the 20, but it does not make sense to use 20 for this part. It doesn't really make it 20. Although the project is 25, but does not make sense to use 20. So our PV of tax foregone on interest saving will be this times this. So now I think we are almost through.
Excuse me.
Yes.
Can you show us how you come up with 4,625.6?
I'm back on that formula.
What I got this times this. The annuity factor times 525.
Okay.
Yes. So what is remaining? I think we have all the variables. We don't have each cost. We don't have each cost on the question.
We have them some.
Each cost?
Yes.
Then it means what we have calculated is wrong. In this question, do you have each cost? Maybe I didn't copy it. Each cost. Where? Do you have each cost in this question?
Sorry, there is no each cost.
We don't have.
Yeah, I think there's no each cost in this question.
Excuse me.
Yes.
What is depreciation amounting to 14 million per annum for 25 with effect from end of first year?
The 14, that's implication of that. Because cash flows are always at the end of year. It means if this is year 1, year 2, at the end of year 1, you will get that 14 million.
Okay.
Yeah. So that is I think we can now get our NPV. I don't know if there's something I've left out. We can cross check also and maybe modify that. So we are now getting our APV. We have NPVU, which we calculated as this, I think. We have the PV, interest on a market loan, which we calculated as it is this one, See the market? See the subsidized. This one, we have a PV interest on subsidized. On subsidized loan, which we calculated as this. We have a PV interest, a PV on interest saving. Interest saving, which we have calculated as this. We have a PV of tax foregone, which is a cost, and it's going to be this one. So my APV will be this. So still you are accepting. Yes? Any question? Any question, members? I know
It's not a question on that, but just on question number B. Because we need to understand that the comparison between the APV and the NPV.
As I said when we are starting, the strength of APV is about financing effect. That's the only issue. If you look at APV, differentiate. If you look at APV and the NPV, the main strength that this one it considers the financing effect. Financing effect of the project. This one does not consider. Does not consider the financing effect. Here I don't consider the financing. The financing effect. That's the main difference, but I'm seeing 5 marks are too much in this. So it does not have anything else, but they need like three, I think, points. But that's the main that for me, I know that he separated these two.
But the fact that they are putting 5 marks, it means that we need to give at least 5 points.
Attached to three on each side. But still, you can check in the marking guide and get those ones. Those for me, I only know one. That one. Okay. So I'm copying this to. I don't know how it. Eh? So members, I think that's it. For this part, which is I said, this is a very common question. Very common question. So please go into deep to apply, but know those steps. The challenge that always, the challenge that is always you need to be very careful is the cost of ungeared. And analyze your costs. Sometimes they can say the current KE is this. Maybe the current KE is 10% or 10%. That's the current KE. Debt to equity ratio, maybe it's 2 to 5, 2 to 4. That's the debt to equity. And our pre-tax KD, maybe is 8%. Automatically, once you see such information, it means you're going to use Modigram and Mira. Because in that case, to get KU in this part, you have to apply a Modigram and a Mira theory. So my emphasis, please look at this question well, look at the cost of ungeared, then apply the debt tax sheet as may be. Where you have each cost, find out if each cost are on net or are on the gross amount. That is my take home on this part, which is a very common area. Please, I don't expect that you'll fail it once you follow what we have talked about. Any question? We are leaving this part.
There are two factors to pass this paper. Number one is our revision. Number two is to give us a lot of exercise.
But I think you have tried that. By exercise, I think if you check the notes, I've given a lot. Isn't it so?
But we will need still to revise with you.
Yeah, but at least every part I give more exercises.
Yes.
I think now the next part should be you to practice.
Yes, it's okay.
Now, we want to end our discussion looking at this last part. It's not very common. I think I've only seen one question. For me, I've only seen one question on international investment. What about you? For me, I've only seen one question, which is on international investment. So it's not a very common, but doesn't mean that we don't talk about it. We can talk about it. Let's give ourselves maximum 1 hour to talk about it. Now, when it comes to international investments, the issue in international investments are like 3 things. When it comes to international investments, number one, you are having foreign currency. It means you have to exchange currency. Number two is the tax. Is the tax effect. That if for example, the head office is in Rwanda, you are opening a branch in Rwanda.
Your voice is not clear.
You know, my voice is still affected by flu, so it's not very, very strong. So I'm saying.
Yes, we can hear.
There are three issues that affect international investment appraisal. 3. Number one is translation of foreign currency. That if you are evaluating a project that is in foreign currency, you have to translate it in local currency. That is issue number one. Issue number two, it's about tax. We know that if you are, for example, opening up an investment in Uganda, you will have to pay tax on the income you get in Uganda. You bring back the income in Rwanda, it pays tax. So you need to look at whether there is a double tax agreement or there is no double tax in the country. And how are you going to incorporate that amount of tax? The third part is the political risks associated with where you are investing. What are the political risks in limiting? They can put a limit on exchange, they can put a limit on amount to borrow, they can put a limit, very many aspects. So those are things that you need. They can also look at, for example, if you are investing, there are subsidies that you may get. You may find that you are getting subsidies on those investments. So you need to recognize, if I'm investing and I'm going to get a subsidy, how am I going to incorporate this subsidy into my cash? Those are the issues to analyze when it comes to international investment appraisal. It's the same, but those three aspects need to be considered in international investment appraisal. So we can say that international investment appraisal involves three key components. That need to be considered in investment analysis. Number one, we have the translation of currency. Translation of currency. Number two, double tax agreements. Double taxation agreement. Number three, we have the political risks. And the government subsidies. Those are the key aspects that you need to consider when you are evaluating these projects which are international. Now, if we look at the first one, which is our key, translation of foreign currency. Translation of foreign currency. So as long as you are dealing with this international, the currency should be translated. For example, if you're evaluating opening up the cash shillings, when you're evaluating, should be translated into. So we have got different methods that we can use in this translation and different ways to evaluate the project. All of foreign currencies related to the project cash flows should be translated into local or the domestic currency. So whenever you are translating, all the foreign currency should be translated either in the currency. So how are we going to do this? No, we have got different methods that can help us to translate. The following methods are used to translate foreign currency. Number one is what we call purchasing power parity. Purchasing power parity. What we call the PPPP. Not the public procurement, but the purchasing power parity. Now, if you look at this theory, they say that the exchange rate is in equilibrium if the purchasing power in one country is equal to the purchasing power in another country, or if one currency can command the same commodity in different countries. For example, if the exchange rate, let's say, if say 1 franc is equal to 2.5 or 2.6 UG shillings, it means if I have 10,000 francs and I exchange the 10 francs into this times 2.6, what 10,000 commands in Rwanda should be the same 26,000 commands in Uganda. In that case, we have a foreign exchange that is in equilibrium. If I come with my 26,000, the commodity I can buy in Uganda should be the same commodity I buy in Rwanda. If we say we are buying a bag of sugar, what I pay to buy a bag of sugar in Uganda should be the same if I convert it at that given exchange, pay to the same items in Rwanda. And then in that case, we have an exchange rate that is in or a foreign currency that is in equilibrium. That's what the theory of purchasing power parity means in this case. Hope we have got each other there. So according to this theory, the exchange rate is in equilibrium if one currency can command the same goods in different countries. Then we shall have, now in this, how are you going to determine the forward exchange rate? So if you are using the purchasing power, this is going to depend on the inflation. If you adjust for the inflation in the countries, we are going to have an equilibrium exchange rate. It means our exchange rate is only a function of the inflation between the two countries. So the exchange rate or the forward exchange rate is a function of the inflation rates between the two countries. The way the currency is going to move is going to depend on the inflation rate in this country.
When they are talking about the equilibrium, they mean equilibrium between the currency.
That's what I get. The example I've given, that if I have 10,100 francs, and 10,100 francs, I can buy a bag of sugar. You get it? If I exchange the 10,100 francs into Ugandan shillings, I should be able to buy a bag of sugar in Uganda.
Okay. Then the equilibrium,
in that sense,
the equilibrium will be
that's
on
purchasing
equilibrium.
power.
Equilibrium on the purchasing power.
It's on the purchasing power.
Okay.
Yes.
So you can write that the sentence one. According to the theory, the exchange rate is in.
According to the theory, this is in equilibrium. If I think that's the word.
Yeah.
Yes. So if you are the exchange rate will move. So it means where the country has than where
I'm not hearing you.
I'm saying a country with a high inflation, its currency will depreciate compared to the country with a low inflation. You get me? If a country has got a high inflation, its currency will depreciate against the country with the low inflation rate. That's what the theory is. Country with high inflation its currency will depreciate against the country, against the currency with low inflation rate. So that's what it means. And if you are to get the purchasing, the forward exchange rate, our FO, which is the forward exchange rate, will be equal to SO into 1 plus HC (1 plus HB). Where FO is the forward exchange rate SO is the spot exchange rate. Then HC is the inflation rate. Inflation rate in the country C. And HB is inflation rate in the country B. And the country C is always, you say, it's the home, it's the foreign country. This one is always, you say, the foreign country. And this one, we call it the home country. So that is how you are going to calculate this. And from there you can get, so the currency, the foreign currency is going to move in relation to your inflation. The higher the inflation, the more the currency loses value. Let's say the current
Scroll up.
Yes?
Scroll up. We need to see what we did not copy. Yes, there.
The exchange rate of FRA to UG shillings is 1 FRA equal to 2.65 UG shillings. The inflation in Rwanda is 6.5%, while the inflation in Uganda is 6.2 shillings. Percent, sorry. So required determine the forward exchange rate. Determine the forward exchange rate. So still we are going to use our formula. So what do I have in this question? I have the SO, which is 2.65. I have the HC, which is 6.2%. And I have the HB, which is 6.5%. So it means if I'm to calculate the forward rate, will be 2.65 into 1 plus 6 point, that is 1.062 over 1.062. 0 65. $1.65. Ooh, I don't know what. Let me do this. So I think I can put a sign here. So what do you get here as your forward rate? What do you get as your forward rate?
2.6.
2.6. 2.6.
6.
So this means the Rwandan francs is depreciating against the Ugandan shillings. That's what it means. The Rwandan franc has depreciated by almost 0.5% or 5% against the Ugandan shillings. I don't know if you have got that. So if now I'm analyzing a project, it means this will be the exchange rate in my year 1, then I can put the exchange in year 2, year 3. If I want to go the exchange rate in year 2, if this is my year 1 exchange rate, it means year 2, exchange rate in year 2. If this is year 1 exchange rate, it means year 2 exchange rate will be 2.6 into 1.062 divided by 1.065. It's the same behavior. 1.065. Hey. Yeah. So what will be the forward rate in year 2? This is year 1. Will be it is what?
$1.7.
Not to 2.
1.67.
1 point.
I don't know if
1 point what?
7.
77.
7.
So this will be the exchange rate in year
67.
in year 2.
Me, I got 2.5. 59.
2 point.
59.
Please check your calculation. Confirmed? Have you confirmed? Sorry, my data had gone. My network. Hope you are now getting me well. What do you get here?
Yes.
Confirmed 1.7?
Yes.
Try also 1.0.
Lecturer, where do you get this? That
The,
F?
the problem, why did you put the zero? There is missing there, yes.
Yeah.
Yes.
But you know, when I round off, this thing is disturbing me like that.
Excuse me.
Yes.
Where are you getting that 1.7 for year 2?
That's what I'm saying. I was waiting.
You're getting it where?
You are getting what? 2.0?
How did you come up with?
No, there was a mistake in the writing, so you can calculate afresh.
It's 2.59.
2.59. So you can go on like that, different years. It means this will be the spot rate in the third year. You get me? If you are going into third year, this is going to be your spot rate. Then you can get the exchange rate for year 3. If you go to the fourth year, the spot rate of year 3, the fourth rate of year 3 becomes the spot rate of year 4 until you finish all the years that you were evaluating. Hope you are there.
So that means for even this second year, the formula is for FO.
Yeah, it's the same. It's forward rate.
Forward rate. It's
Yes.
better you put it there, otherwise it's going to confuse.
No, it is. So FO in year 2. So year 3, you go like that. Year 4, you could do like that until you look at all the years that you were evaluating. So that is it. Then we can look at, we have what's called interest rate parity. We are looking at how we can determine the forward rate, which we can use in our evaluation of project. The first method, we said we use the purchasing power parity, which relates the exchange rate with inflation. The second method we are looking at is what called interest rate parity. Interest rate parity. Now, in interest rate parity, it is that the exchange rate will move in the same proportion as the movement in interest rate. As interest rates are moving up or down, the exchange rate will move in the same direction. That's according to the interest rate parity theory. Exchange rate moves in the same proportion as the movement in the interest rate. So if your interest rate goes up, we expect that your currency is going to. If your interest rate goes down, we expect that the currency is going to appreciate. So the movement in the interest rate is in the same proportion as the movement in exchange. That's the interest rate parity.
We are not getting your voice.
We are saying think the voice is starting to reduce. The hours have been many. We are saying, if you look at the interest rate parity theory, the exchange rate between countries moves in the same proportion as the movement in the interest rate. So if the interest rate goes up, the exchange rate will depreciate that currency, or the currency will depreciate against the foreign currency. If the interest rate goes down, the currency of that currency will appreciate against the other exchange rate of the other currency. That is the interest rate parity. So we can say that according.
So it is the inverse relationship.
Yes, it's an inverse relationship. Even there, it's an inverse relationship. According to this theory, the exchange rate moves in an inverse relationship with interest rate. That is, an increase in interest rate leads a depreciation the foreign currency in the currency against the other currency, and the vice versa. That's what I can say. So if your exchange rate increases against, your interest rate increases, it means your currency will depreciate particularly the currency against the foreign, against the foreign currency. Automatically, your currency will depreciate against the currency, and that's going to be vice versa. So still, we have the same. If we are using, how are we going to get the forward rate? The forward rate, which is our FO, it will be equal to the spot rate into 1 plus IC over 1 plus IB. Where IC is the interest rate in a foreign country. IB is the interest rate in the home country or the base country. SO is the same, it's the spot rate, and FO is the forward rate. We talked about that. SO is spot rate. Not spots, spot rate, and the FO is the forward rate. So that is how you are going to determine your interest rate. I think I can give you this and you try. You can try this and tell me the answer. The current exchange rate of USD against RA is 1 USD equal to 1346 RA. The interest rate in USD is 9%, while the interest rate in Rwanda is 8.5%. Quiet. Determine the exchange, the forward rate. The forward rate in year one and 2. Please do this one. Get the exchange rate in year 1 using the same.
Is it the interest in USD or in US?
Huh? That's the interest in
Is
US.
it the interest
In the US and in Rwanda?
Yeah, then you're correct.
Yes.
You're correct there. The interest in US.
But when we say USD, that is US. Automatically. Year 1, you got what? Year 1, what do you get? Members, you are delaying. And time is getting us. I said we are finishing at 4. We are remaining with one part or 2 parts. What is wrong? What have you got in year 1? Yagenze gute Kachweta zafuye?
tubikorere hamwe.
Oya no kushyiramo hariya muri formula. Ese nacyo kirakomeye. Ese Kachweta simwe muzifite se? Ngewe na Kachweta mfite. It's going to be 1, 3, 46, 1, 1 plus 0.09 over 1 plus 0.085.
Are they all minuses?
Yes?
Are they all minuses?
Where is the minus?
The random rate.
No, it is not a minus, it is a plus.
I mean, are they, it's the bracket.
Yeah, it's a bracket.
I mean, according to the formula, the above one was the one that is a minus.
No, we have no minus. Yeah.
What about the bracket? What's the meaning of the bracket?
Huh? Not just to separate this and this. You know, other issue with bracket. It's about separating this. I would have used this thing.
Oh, okay.
That is 1352.2. 1352.2.
Then what about year 2? This is year 1. Then I want year 2.
It's 1358. 0.4.
Yeah, that's how you move with your exchange rate using the interest rate parity.
Excuse me, lecturer.
Yes.
We always start with the currency with depreciated low value.
Because because since we are in Rwanda, we take Rwanda as the best currency, the best interest.
No, but the previous example, it was Rwanda against Uganda. But with, sorry.
No, we had the foreign and the home.
Yes. In the previous example, you see, for example, we start with the value of Ugandan currency.
Because that's the foreign.
Yes, but in the correction of this one, we start with the value of Rwandan francs against the.
What is the Rwandan franc? Is it the 9 or it is the 8.5?
No, it means 1 USD is equivalent to 1,346 Rwandan francs. That's why I was asking whether we should start with the low value currency.
Oh, it's because what we are valuing, because in the other part, Rwandan franc is stronger than the Rwandan. I would have used the Rwandan 4.5. Maybe I would have used that.
We are not getting a voice, please.
I'm saying, in the first example, Rwandan franc is stronger. Is a stronger currency compared to Ugandan shillings. That's how it was like that. This time, the US dollar is stronger than Rwandan franc. That's how it's written like that.
So we should always start with the
stronger
currency. Weaker currency.
Yes.
No, weaker currency.
The weaker currency.
Okay.
So let's look at the. This is what I've written. This one I've finished. How come I'm not seeing anything? This is the title I wrote. The title was Fishers. Fishers International Effect. That's the number 3. When you want to translate, the first was purchasing power parity. We looked at how we do using the inflation. The second, it is about interest rate. And the third is what we call the Fishers International Effect. So in the Fishers International Effect, we look at the relationship between inflation rate and the interest rate. In fact, you are combining number 1, which is purchasing power parity, and you are combining the interest rate to determine the cost or the interest that you should use. So according to the Fishers, the Fishers International Effect, there is an inverse relationship
Excuse me, lecturer.
Yes.
So those for the exchange rate. we are calculating, are they the one that we are going to use in the
in
discounting, the evaluation
of the project?
Okay.
Because that's what you need. Other parts are okay, but what you need is to translate the currency into the home currency. There is a relationship, an inverse relationship between.
Then why, if translating into home currency, why are we using for the rate?
Because
instead of spot rate?
Now, because when you are, for example, when you make an investment, when do you expect the cash at the end of the year? Isn't it so?
Yes.
So we are looking at, if the spot rate today is 1,346, what would be the exchange rate at the end of the year?
Okay.
You get it?
Yes.
And then from there, then what would be the exchange rate in year 2, at the end of year 2, which you are going to use to translate your cash flows. So in this, we are combining the purchasing power parity. We are combining the purchasing power parity and the interest rate parity, but in an inverse proportion. We talked about purchasing power parity. So in this, we are not calculating the forward rate, but what you calculate, you can calculate the cost in a home country, or you can calculate the cost in a domestic country using the Fisher's international effect. So how do you get this? It is 1 plus HC over 1 plus HB is equal to 1 plus IC over 1 plus IB. That's the Fisher's international effect. We are about to finish, Diane. I think we shall finish this part.
It's going to read.
Yeah, we are about to finish. Let's finish this. Then we shall do an example. We shall do an example on Monday, tomorrow. So here we use this to determine either the cost in a home country or the cost in a foreign country. For example, if I'm investing in Uganda and I have the cost, what is the current cost in Rwanda? I have the inflation. I can be able to get the cost of capital in Rwanda. I mean in Uganda, that I should use to discount those cash flows in Uganda. In that case, you're going to use the Fisher's international effect.
Come again, please.
I'm
Your
saying,
voice is not coming away.
Maybe also the voice is tired. If in Uganda, you have a head office in Rwanda and you are investing in Uganda, and you have the inflation in Uganda, you have the inflation in Rwanda. you have a cost of capital, which is in Rwanda.
Yes.
And you want to determine the cost of in Uganda that you should use to discount your cash flows. In this case,
we did not get that one.
You want to determine the cost of which you should use to discount the cash flows in
the cost of what? Sorry?
The cost of capital to discount the cash flows in Uganda.
Okay.
Because the cash flows are in Uganda. In that case, you are going to use what we call the Fisher's International effect to get that cost of capital.
When there is the cash flow is in a foreign country, this is when we use the Fisher's International effect.
Now we have two methods that I want to introduce, then we close our discussion. There are two methods that I want to introduce on how to evaluate cash flows in foreign currency. Let me introduce this. I'll do the example tomorrow and summarize this part. Evaluating cash flows in foreign currency. How to evaluate cash flows in foreign currency? We have two methods we use. First method one. Method number one. Adjust all the cash flows, okay, or determine the project cash flows and incorporate the information in the cash flow. Determine all the project cash flows and incorporate inflation in the cash flows. That's step number one. You're going to determine all the project cash flows and incorporate the cash. For example, if you're investing in Uganda, you need to identify what are the cash flows that are related to this project in Uganda. Then number two, translate all the cash flows, into a local currency or domestic currency, into a domestic currency. That's where now you need to get the exchange rate for each year. Year one, year two, what's the exchange rate? Translate all those cash flows into the domestic currency. Step three, discount the cash flows. Discount the cash flows using a domestic cost of capital. So it means if you are to follow this method, you have to get the exchange rate for each year. You have to get the exchange rate for each year. Then once you have your cash flows, get the exchange rate for each year, discount the cash flows using the domestic cost of capital. Now, if you use the method 3, method 2. If you use method 2, step number 1 is the same. You're going to determine all the relevant cash flows of the project. This one is the same. You're going to determine all the project cash flows and incorporate inflation in your cash flows, if there is inflation in the country. Then step number 2, you are not going to translate, but you are going to discount the cash flows using a foreign cost of capital. Now, that's where you have to use the Fisher's International. Discount the cash flows using a foreign cost of capital. You have got all your cash flows, discount them using a foreign cost of capital. Then step number 3, convert the NPV. Translate the NPV to domestic currency. Domestic currency using the current spot rate. Translate the NPV to domestic currency using the current spot rate. So these are the 2 steps that you can use when you are evaluating projects. When you're evaluating projects, so it depends. It means if you're using method 1, you have to get the exchange rate for each period. Yes, please. If you're using method 2, you only need to get the foreign cost of capital using the international Fisher's effect, and then translate the currency, the NPV to domestic currency, but using the current spot rate. So I think we shall look at an example in our tomorrow's class. If you don't have questions.
Before you leave, lecturer, we did not capture your message on when do we have to use Fisher's International effect?
In method
discount the
in method 2. Because in method 2, you need to get the foreign cost of capital. You get me?
Thanks, better you're right. Yeah, you can maybe to clarify this. To help us remind, you can put on the method 2 but in bracket Fisher's International effect. Yes.
Discount the cash flow using a foreign cost. Maybe I can add a sentence here. Cost of capital determined using Fisher's effect or international effect. That's, I think, what you are saying. In this method, you have to use the Fisher's international effect to get to the foreign cost of capital. And from there, you can be able to Is it okay now?
ejo tuziga sangahe?
Si saa 12? Ejo muratera gihe muvuye mu matora murava mu matora sangahe?
Zarangira
oya ni saa 12 n'ibyo kubera ko oya ntabwo twafatamira saa 12 kuko buri wese ntabwo amenye igihe azavira mu matora.
Tuzahera ku minsi.
Hano amatora azarangira saa 9.
Ariko amatora azarangira saa 9.
None
niba amatora azarangira saa 9, why not tutatangira kwiga saa 9?
Reka reka
Dutangire
amatora
saa
yarangira
kumi
saa
n'imwe
9
kugira ngo turangize kare. Yego.
yenda ahubwo saa 11 ariko ntabwo twatangira saa 9 n'ishoboka.
Twatangira saa 11 ngo turangize kare nabyo byaba byiza. Okay. So let's stop here and then we meet tomorrow. I'm going to share this one is not complete. I will share it tomorrow after the example. So I'm going to share the other one.
No, you share it today because the other party are copying the lecturer. You are using to share it. We need to copy them. The party are copying.
Yeah, it's better to share it right now.
Yes.
Then we complete our notes lecture.
Yes.
Okay. I share the what? The PDF, the Excel. Okay, let's stop here and then we meet tomorrow at 5. That's what we have agreed. Okay, have a good matora. Have a good matora tomorrow.
Thank you, sir.
Thank you.
Ntabwo uzatora ko usigaye ikinyarwanda.
Nzi ikinyarwanda ariko nta ndangamuntu mfite. Okay, so have a good night.
Ukuzaguha ubwenegihugu.
92.